Perhaps some of the earlier spending was part of a contributing factor to this. I mean, this is sort of the picture that we're looking at that is so difficult to decipher. Is this a feeling that he can't get anything done in Washington, or is it also a reflection of the sentiment surveys, which have come in really spotty, this idea of people feeling the price of milk, the price of gas, the price of housing?
John, speaking of struggling in the polls, can you explain how the Manchester United coach still has his job?
Yeah, I don't know, Tom.
I mean seriously, this guy's a nice guy, right?
Brutal.
He's like a Ted Lasso guy.
Tom, do you know what captured that perfectly? It was a picture of Sir Alex Ferguson looking absolutely miserable. And then the next shot on NBC, Tom, just showed Kenny Dalglish, Liverpool legend, laughing his face off.
John, seriously, and I can't pronounce his name, I'm so sorry, with no disrespect. John, the good coach of Man U, is he the closest to Ted Lasso in soccer?
No, Tom, he's not. And I don't think he'd appreciate that this morning, though. I'm sure some Manchester United fans feel that way. Tom, that club has got problems, big issues, and that team has got bigger issues as well. Harry Maguire's worth how much?
I don't know.
Too much.
I don't know.
That defensive performance of him and Shaw.
Did you see the corner kick West Ham scored on?
I saw some of the goals over the weekend, Tom.
What was Harry Kane doing?
You upset about Spurs? He wasn't defending, Tom. He was not defending his man.
Thank you.
Should have marked him better.
It was poetry.
Is that the football done for this morning?
Steve Major emailed me.
Steve's happy.
It was poetry, I said.
In a Champions League race now for West Ham. This is Bloomberg.
Did I do okay there, John?
countries, Francine, that are the equivalent, that equal 80% of all the emissions. Those 20 countries, above all, have to step up.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
3 weeks of gains on the S&P 500 from New York City this morning. Good morning, live on TV and radio. This is Bloomberg Surveillance, and here's the price action. Equity futures just a little bit firmer, up 6, advancing a little more than 1/10% on the Nasdaq, up 1/4% on the Russell. We're down about 1/10%. The big 5 tech firms reporting through the week. We'll hear from Facebook a little bit later. That's the equity market picture. Here's the bond market story. 2s, 10s, and 30s shaping up as follows. Yields higher now after a big move lower on 10s and 30s. On Friday, after we heard from Chairman Powell, up by 2 basis points to 165.55, up about 3 on 30s to, let's call it, 2.1%. But that front end now, very little pushback from Chairman Powell on Friday seems to be the takeaway from the likes of Neil Dutter of Renmark. We can build out that through the program this morning. They're starting to push out this transitory call now. Transitory for longer is getting to be something we hear a little bit more of, Tom. Something maybe people are getting increasingly frustrated with hearing. That's the bond market. Switch up the board and get to the Turkish lira. Tom, your favorite currency pair? Dollar try, all-time highs. That's record weakness for the Turkish lira. 1.4% move in the dollar's favor, Tom.
Very quickly here, it's about Turkey, John. I get that. It's idiosyncratic, but then it's not. It's about the political projection of Erdogan back to 2002 in the Levant, his view of modern Middle East, and then it's a projection where you go, when does it become contagion? We're not there yet.
Take your pick right now. They cleared out the central bank, 1. They cut when everyone else is hiking, 2. And now they're clearing out the ambassadors, it seems, Tom.
Yeah.
Dollar lira with another big move, 974.
Are you done?
I'm done.
Okay, well, this is fun. I'm so ready, I can't stand it. This is really important, folks. It's 220 pages, and for the first time in ages, I'm going to say it's a cover-to-cover read. Foreign Affairs Magazine, Dan Kurtz-Phelan joins us right now. It's on his wheelhouse, China, and it is absolutely spectacular. Let's get to it. Dan, congratulations. So let me start with my essay of the year by Dr. Bremer of Eurasia Group. He sits there and folds in the technology companies into your international relations. Explain the international relations of Amazon.
That's right. So Ian Bremer's contribution here is not just to point out what we all know, which is that tech companies are hugely important. They're major actors in shaping the world, but they've really risen to the point where they are like states themselves. And what this means is that when you look at the big players, not just Amazon and Alphabet and Facebook and the American players, but also the big Chinese tech companies, the big tech companies elsewhere, which model of tech company wins out in shaping cyberspace is really going to determine the geopolitical future, not just the future of technology. So it's become a very different game.
You went for sales. You put Mearsheimer in the book, and you're always going to move more copies of Foreign Affairs. A gentleman who went after NATO and went after continental Europe as they faced Russia a decade ago. He's scathing here on the U.S. approach to China and says the United States is ignoring realist logic. How realist is the Biden administration?
John Mearsheimer loves to go after what he sees as the big mistakes of American strategy and American foreign policy over time. What's really remarkable in this essay, where he looks back at U.S.-China strategy over the past several decades, he calls this the biggest strategic mistake we've made in the history of America's time as a great power. What he sees is this mistake of thinking that China would become more liberal, more acquiescent, more like the United States. Instead, as we all know now, the opposite has happened. It's become more assertive. Its political system has not liberalized, and Xi Jinping has proved to be the most kind of assertive Chinese leader since Mao. The Biden administration, as we can see, and Richard Haas's essay makes this point, has really kind of extended the recognition that started probably late Obama and then really under President Trump, the idea of China as our main competitor, and in some ways the kind of focal point of American foreign policy. The Biden administration's China policy has been very tough, very assertive, very hawkish in some ways. And that's been a change in American foreign policy that really goes across both parties. We talk about, partisanship in Washington, but this is probably the most bipartisan policy we have today.
What's the goal then, Dan, if this is the new approach for a longer period of time, especially at a time when the trade deficit continues to deepen between the U.S. and China?
So you're asking the million-dollar question. We've decided that we need to be tougher. We've decided that this is the central challenge for American foreign policy. But both parties have really struggled to figure out where we go from here. So if we think about what an end state is with China, the Chinese Communist Party is probably not going to go away. Xi Jinping's probably going to be in power for some time to come. We're still going to have to cooperate with China on issues like climate change. We're, of course, approaching this massive UN climate change conference in Glasgow in a few days. So we need to find a way to coexist in this world, even while, from the perspective of U.S. foreign policy, you're able to push back on some of these very worrying things that you see from China in its own region, within its own borders, and globally. So there's this ongoing quest to figure out where this all goes, what goal we are aiming for. And I would say that, that's a question we'll be trying to figure out in our pages over time. It's also a question that policymakers in the U.S. government and the Biden administration and beyond are going to be really grappling with.
Well, the goal for the Facebook state and the state of Amazon is quite clear. It's to make money. And we do see this increasing shift into China despite some of the hardened policy from the United States, as you were talking about earlier. How does the U.S. or how should the U.S. respond in terms of regulating the U.S. business interest over in the China mainland?
So this is one of the most interesting elements of that Ian Bremmer essay. This notion that these tech companies are both critical to national power, right? If you look at U.S.-China competition, one huge piece of that is who's going to have the technological edge when it comes to everything from AI to quantum computing, to cyber tools. And as we all know, the private sector actors are really, really central in that. So even at this moment when these private companies, the ones you mentioned, as well as many Chinese companies that have become really, really major global presences in various tech sectors, even as they become these huge private sector players, when we talk about U.S.-China competition, when we talk about U.S. power, a lot of that comes down to who's developing technology faster, who's developing AI and quantum computing and everything else.
Dan, it'd be unfair if I didn't ask you of your knowledge back to George Marshall and China of another time and place. Give us the Kurzweilen once over on Taiwan as it stands now. How should the United States project a modern George Marshall to Taiwan and to mainland China?
Well, thank you, Tom, for bringing up George Marshall, which is a topic I spent many years of my life working on. When you look at Marshall's approach to China, it was all about balance. So you needed to be, in some ways, tough and clear and strong, but also needed to be really aware of risks and limits and balance those two things. And that's exactly what the U.S. is trying to do in Taiwan today. We can see that China has become much more aggressive, at least in its rhetoric, when it comes to Taiwan, when it comes to reunification with Taiwan. And the U.S. is trying to, on the one hand, project strength and project a certain commitment, but without going so far as to increase tensions even more or encourage risky behavior by others. So it really is this really fine balance. And it's a very dangerous situation. And you can see if you have Chinese planes in the Taiwan Strait, you have all these commitments, it could escalate really, really quickly.
You are advantaged by Elizabeth Economy at the Council on Foreign Relations. She was shockingly prescient a number of years ago of the domestic challenges to President Xi. Why is Xi not left home? From where you sit and with all your contacts, is President Xi threatened by domestic affairs?
Well, I'm happy to tell you, Tom, that we'll have an essay from Liz Economy in our next issue, which will get at some of these questions.
Well, get us out front now.
But
Pharaoh's already Pharaoh's on that.
I will give you a preview. From outside, it's easy to see Xi Jinping as this just incredibly powerful leader who has this hold on Chinese power, on Chinese government in a way that we haven't seen in a very long time. But when you look at the just array of threats to his power, whether it's demographics, it's environmental stuff, but some of the threats to the Chinese economy, I mean, you would know some of those dimensions better than I. He's got a lot of reason to worry. So he's going into his own party Congress next year, trying to secure his own power for another 5-year term. But he's got a lot to deal with at home. And you can imagine why, if you're sitting in his position, you'd feel a lot of insecurity as you try to reckon with some of those threats.
Hey, Dan, great to catch up. Important topic at the end there, too. Dan Kurtzfield there of Foreign Affairs. Tom, I believe the Chinese Communist Party leader has not left the country since Wuhan was locked down. It's been a while.
Yeah, well, it's a city-state structure there. I studied it over the years, John, for a number of different reasons. But the bottom line is he needs the support of Shanghai. He needs the support of the cities surrounding Hong Kong and on and on. And there's other cities that I can't pronounce. The bottom line, John, is it's very different than our federal view of the red doors in Beijing.
Capturing that story to some degree, Tom, just a small part of it. There was a report in the Wall Street Journal over the last couple of weeks that Xi Jinping would like a property tax, and there's been pushback within the party. And that's just a little sign, Tom, that the leader of the Communist Party in China doesn't always get his way.
But can I also suggest, John, it folds right into this week for Bloomberg surveillance, in that you wonder how these big tech companies are going to address China, not only for demands, sales, and that, but the manufacture of their product with Taiwan Semiconductor front and center.
Depends what their presence is. Facebook will have a very different view to, say, Apple for very obvious reasons.
I was just trying to pull international relations back into,
saw
John,
that,
what
Tom.
we do.
We can do that.
Okay
we
there?
can do that a little bit more if you want. Prime Minister Boris Johnson, Tom, saying he's worried the COP26 climate summit may not secure the agreement he wants on cutting emissions. No one's shocked by that line, are they, Tom? That conference taking place at the end of this month.
And we're setting up for this now, John. And, you know, I did a panel on COP26 X number of years ago at Davos, and it was a jumble there, and I think it's even more a jumble now.
Managing the message this morning, Tom. A week out. From New York City this morning, good morning. Tom Keane, Lisa Abramovitz, and Jonathan Ferro.
Three of us in Glasgow.
Tom trying to arrange another step on the European tour. Another stop, Tom, this time in Scotland. Equity futures up 6 on the S&P, up a little more than 1/10%. 3 weeks of gains. We look to add to it.
It's like $5,000 a night.
In and around all-time highs on the S&P. From New York City, this is Bloomberg.
With the First Word News, I'm Laura Wright. West Virginia Democratic Senator Joe Manchin appears to be on board with the White House proposals for new taxes on billionaires and certain corporations to help pay for President Biden's scaled-back social services and climate change package. CNN is reporting Manchin is okay with a $1.75 trillion package. That follows a meeting on Sunday between President Biden, Manchin, and Senate Majority Leader Chuck Schumer at the president's home in Delaware. U.S. labor shortages will persist into 2022 and contribute to a permanent increase in business costs. That's according to the latest survey by the National Association for Business Economics. Some 36% of respondents currently experiencing worker shortages said they expect them to end at some point next year. None see it happening before the end of 2021. 14% see shortages abating in 2023 or later. HSBC is outlining a bullish outlook for the months ahead, fueled by likely increases in the interest rates. The London-based lender also said today it will soon kick off a higher-than-expected share buyback. Adjusted pre-tax profit rose to around $6 billion in the third quarter, beating estimates. Revenue climbed slightly in the third quarter for the first time in almost 2 years. And Michael Jordan's earliest known regular season game-worn Nike shoes sold at Sotheby's auction in Las Vegas Sunday for $1.47 million. Jordan wore the shoes in his 5th NBA game during his rookie season in 1984. They're the most expensive sneakers ever sold at auction, but not the priciest shoes ever sold. In April, the company Rares bought a $1.8 million pair of Kanye West Nike Air Yeezy One sneakers. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
someone wants a leader, is it better to find a general or an admiral?
That's like asking me to say, who do you love more, your son or your daughter?
When you look at technology, how should we be looking at big banks and technology?
Technology is our friend. So it's helping us transform the bank fundamentally. And in fact, we're speaking, I think, as we speak, to our shareholders around what we've done and how we've transformed the bank. We also see technology and technology companies as partners. So some
not
of our
rivals.
You know, we know that there are big parts of what have been our business historically that will be absorbed into convenience platforms. And by convenience platforms, whether that's Amazon or Facebook or Alibaba or Tencent or something like that, those are platforms that are just very convenient for people to conduct their day-to-day financial affairs. And it'd be very difficult for a bank to compete with that. Now, in some cases, I'd say, let's say in Africa, we are setting up a competing platform to the convenience platforms. And we're working with technology companies and mobile telephony companies and others to create a platform of our own. But for the most part, we're going to be playing on somebody else's platform.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
What really shouldn't be confusing, all three products. The mix and match means that under the situation, if you were originally vaccinated with one product, could you and would it be appropriate and safe and effective to get boosted in the third shot for the mRNA and the second shot for J&J by another product? And the answer is it's perfectly fine.
Dr. Fauci on ABC over the weekend from New York City this morning. Good morning. Tom Keene, Lisa Abramowitz and Jonathan Ferro. Your equity market up 6 on the S&P, up a little more than 0.1%. Into the bond market, yields are higher after traveling lower through Friday's session, much lower. 165.55 on 10s. It is the blackout period for the Federal Reserve. There will be no Fed speak this week. I know you're all happy about that. You will get a Fed decision, Tom, next week, November 3rd, and a Chairman Powell news conference too.
Next week, going into our special programming for that event, it will be most interesting. John, we've got to note Brent crude above $86 a barrel. I believe that's closer to $90 than $84
Keep picking up. WTI, 84.50, Tom, 84.40.
On the pandemic right now, I'm going to dovetail two stories here. There is the joy, the true joy from Canada, as they announce coming up here very shortly, all kinds of travel can reoccur, including going to see the Montreal Canadiens try to win again. And then dovetail that with the vaccination of our cherubs. That is very emotional. Joshua Sharfstein joins us right now, Vice Dean, Johns Hopkins Bloomberg School of Public Health. Mr. Bloomberg has a nodding acquaintance with his TV and radio network, and of course his philanthropy is too his Johns Hopkins University. Dr. Sharfstein, I look at this, and as you mentioned as we were going to air here, it is about a gaining of confidence. We get confidence when we see Canada truly open up. We learn confidence when we do something new in vaccination, such as our cherubs.
That's right. And, you know, in general, the projections that cases would go down are coming true, and we hope that that'll continue. And, you know, that's what the projections show. The question is how low they'll go, and that will depend really on how many people get vaccinated and on whether people can take precautions if in places where the cases are going up.
Do we need a new messenger for all of this? Tough question to put to you, sir, but do you think Tony Fauci, Dr. Fauci, is helping when he's in the media every single weekend saying the same thing? Do you think that helps at the moment?
I think there are a lot of people who come to rely on him. I think people would be a little anxious if suddenly he didn't show up on TV to explain, what is going on. I also think there are other very good messengers, including Dr. Walensky at CDC, who are able to explain what's happening. In general, I think it would probably be helpful to be talking a little bit ahead about what things are coming. And I think they've done a little better job of that as the pediatric vaccine is approached. But what I think is going to be really important is explaining not just the decision for the pediatric vaccine, but how additional data will be quickly gathered so that people who are reluctant initially are able to get questions answered.
Dr. Sharfstein, how important is tomorrow's FDA meeting?
I think it's pretty important because, I think in this country, we don't do so well if people just announce things without really explaining them. I think some of the challenges we've had this year because things have been announced before they've been explained. One of the advantages of an advisory committee is that people talk over the data, they talk about different things, and that informs journalists, it informs people who are watching really carefully, but more generally, it just kind of creates this idea that we've really looked at the data before we're making a decision to go forward. And I think that'll be helpful. And again, I think a key point is that it's not a point in time decision. It's a current, decision, which I think will likely be to move forward. But at the same time, they'll be collecting more data as that happens and as many, many kids start to get vaccinated.
Increasingly, the question will be, what is the new normal that we should be comfortable with? And I say this as certain banks start to pressure Hong Kong to move away from their zero COVID policies to actually reopen their borders, even if they see a couple of cases. What is the appropriate new normal that we should be looking toward, and when do we get there?
Well, I think, we're starting to get there in a lot of parts of the world. Even New Zealand is making plans or starting to open up with high levels of vaccination. I think for me, I'm going back to school. I teach in person. We still have masks inside the school public health. But as the number of cases in the community goes down and as the vaccine continues to hold up, those precautions might also go away. So I think we need a little bit more flexibility in the new normal, recognizing when there is a surge in the community, we should do more. And I think masks are going to be a little bit like umbrellas. There'll be periods of time where it really does make sense to wear masks, and that may be even to protect us against flu.
Where we have hot spots, are we having lesser hot spots now?
In general, yes, although there are certainly some places. I was reading about Minnesota, parts of Minnesota. I mean, this is a virus that will find the places that are unvaccinated, and if those places don't have a lot of hospitals, then you're going to see a real healthcare crisis, and that is continuing to happen at a small scale. I think so many people got Delta over the summer that we've been spared that a little bit in the places that were already hit hard, but we don't know exactly what's happening with the virus. It may be mutating a little bit more. And so I think really until we have a very high percentage of people vaccinated, there's going to be this risk, and we're going to have to remain flexible.
Doctor, thank you, as always, for your time. Joshua Sharfstein there of Johns Hopkins. Tom, Beijing, the focus here, China more broadly. I think for a lot of people waking up, thinking about supply side issues and thinking about the pandemic as well. The capital, Beijing, has all but banned entry by people arriving from any place in the country that's reported locally transmitted COVID cases. The restrictions, Tom, are tighter.
It's dead on that you do this, John, because we're seeing Canada open up. We're seeing some real successes where we live as well, and the hotspots just mentioned by Dr. Sharfstein. But the rest of the world is a completely different story with national hotspots. And then, it's almost every nation for itself, I'd say.
So let's get to the economics debate right now. Secretary Yellen has said that these issues will get better perhaps by the middle of next year. Lisa, a lot of that's going to be pinned on, say, one country and things getting better in places like China. Never mind the domestic story at the ports in California, here in America.
The idea that their policy with respect to COVID is becoming international debate. The idea of zero COVID, that they don't want to see anything, that one death is one death too many in Hong Kong and in the mainland. How do you then dovetail this into supply chains getting evened out? How do you get this into an economy that's that much more hinged on importing goods? Look, there was a recent NABE survey that showed that no business expected these issues to dissipate this year.
Have you noticed that the messaging has changed, just shifted a little bit from Secretary Yellen, from Chairman Powell?
I did notice
Have you noticed that? It's just been pushed out just a little bit more. They're pushing out this conversation to the middle of next year. What happened to year end? What happened to as the year progresses? Now we're talking about 22.
Exactly. I went back and forth with Dr. Larian this morning over at the University of Cambridge. And John, the basic idea is their sole single solution is to push it out, as you say. There's no other history. Read your Meltzer, read your Timberlake, read your Friedman and Schwartz. Push it out, push it out.
Does the T word still work? I don't think it does, Tom. Tom Key.
T word is going into the grave of a V-shaped bottom.
Lisa Bravitz. Jonathan Ferro.
Are you okay there?
That was beautiful.
Gorgeous.
Poetry,
That's
Tom.
before you were on air.
That was poetry.
Thank you.
Up 2 basis points. You're still live. 165 on 10s from New York. This is Bloomberg.
As Magnus TV in Facebook since I'm streaming Axie Infinity. Axie Infinity is an NFT game where you can earn tokens, and then that tokens can be converted into pesos. I'm playing almost 4 to 5 hours a day. I'm earning, I can say it's really a lot of money. It can help to sustain my family needs and also to sustain my own business that I'm starting. I'm a little bit worried about it because some people who join this Axie Infinity thinking that this is an easy money game. They can earn a lot on this game. This game can sustain their life. And I think that is not the point, or that is not really the game. We are trying now to build a community where other players or my scholars can join this esport, playing Axie Infinity for now, even 5 years, I think.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
Inflation goes to the point where the Fed has to raise rates, they're out. If the stock market corrects, they're not coming back.
Yes, inflation is a focus, but the market has priced a good amount of that.
What markets are pricing in at the moment is an acceleration of the Fed hiking cycle.
Inflation expectations are rising, and what they need to do is manage those expectations.
Rising interest rates is a sign of confidence in the economy, not a problem for stocks.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City, for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your equity market up 5 on the S&P, advancing 0.1%. This week, Tom, we've got to put the obsession with the Fed to one side and focus on big tech.
I'm going to focus on big tech, John, and really the headline I had it last hour as well is not only earnings surprising of 117 companies. John Stolfus at OPCO nails it with the idea that revenues are double-digit, John. They're not nominal GDP, 6-7%. So far, we see another quarter of pretty darn good sales growth.
We don't have some good headlines, though, Tom, on Facebook. Here's one for you. Alarmed by the drop in teen usage, leaving investors in the dark. A big story, Tom, that we've just put out in the last couple of minutes. Lisa, the stock is negative about 1%.
Yeah, the idea here that teenagers are starting to spend a lot less time on Facebook. This comes among the drumbeat of disclosures from Frances Hogan, which we have seen just sort of bleed out here. The idea, what is the future for a Facebook that has been at the center of discourse for the United States, that has frankly remained out of the purview of regulators for so long?
Just want to get to our story, Tom, and read it verbatim for you. In March, a group of researchers inside Facebook compiled a report for one of the company's most powerful executives, the Chief Product Officer, Chris Cox. The paper included a series of charts and data highlighting a troubling trend that seemed to be accelerating. Facebook was losing popularity with teens and young adults, Tom. Some of the reporting here at Bloomberg this morning.
Did they go to Instagram? That's what I observe at home, John. I mean, I really wonder what the lose-lose sum total is here for Facebook. I mean, it's very good research here. This idea from Kurt Wagner and David McLaughlin as well. But I just see, I'm sorry, where did they go? They went to Facebook. We see that at the Keene household.
Well, here are the numbers. One colorful graphic showed that time spent for U.S. teenagers on Facebook was down 16% year over year, and that young adults in the U.S. were also spending 5% less time on a social network. Happy to say that joining us now is Bloomberg's Paul Sweeney. Morning, Paul. More bad news, it seems. A toxic atmosphere. It's been reported on a lot over the last several months. In fact, the last several years for this company. Paul, what are we learning this morning?
Yeah, it's a big issue, I think, for this company. When you think about these social media companies, the real proposition they provide for their advertisers is, we're going to give you a big audience, and they do. There are billions of people across all the Facebook platforms, and we're going to give you a lot of engagement. That is, our audience spends a lot of time on our platforms, whether it's Facebook or Instagram or eventually WhatsApp. So to the extent that a certain demographic, like teens, are spending less time with one of their platforms, in this case Facebook, that's an issue. That goes to their ability to generate advertising revenue. So, this is something that's going to, I think, be an issue for this company going forward. They're really going to have to manage their way through it with their advertising partners. But, boy, you look at the stock, it's up 18 or 19% this year, generally in line with NASDAQ. So it hasn't been that big of an issue yet, but you got to feel like this is pretty fundamental to the core of their business.
8 years track record, Paul Sweeney. They're up a slurry soft 26% per year. Ian Bremmer in Foreign Affairs has my essay of the year of the power of Facebook, the power of Amazon, the power of big tech. Does anybody at Facebook's headquarters, I don't even know where it's located, but, does anybody at Facebook's headquarters give a damn what the media says about their demographics and dynamics?
I think they do. Again, they're dependent upon advertisers, and to the extent an advertiser doesn't necessarily want to be associated with your platform, that could be an issue.
Okay, but they go over to Instagram.
They go over to Instagram, but again, that could be an issue as well, because I think what a lot of folks don't understand is that Instagram obviously is owned by Facebook, but it's not necessarily out there in the zeitgeist, but to the extent that it does become a bigger issue, this is something that I think they need to get a handle on. And the current management team, doesn't seem to have the ability to really get ahead of this very much. They don't perform that well in front of the representatives down in Washington, D.C., so I think that's going to be an issue for them. So if you're Facebook, you'd like to think you can get in front of this because it goes to your core proposition for your business proposition, which is really to advertisers, delivering a huge audience with big engagement, and that's kind of been the story here. And so if you're an advertiser, it's kind of a duopoly, a triopoly. You've kind of got Facebook, you've got Google, maybe Amazon a little bit, but you're kind of left with Facebook and all the properties they have.
Paul, what do people want to hear from Mark Zuckerberg today after the bell when they deliver their third quarter earnings?
Well, I think they're going to want to hear that they've got a handle on their business and that they are, in fact, allocating a lot of resources and trying their very best to deal with these issues. And there's a myriad of issues, as it relates to data privacy, hate speech. Obviously, the elections coming up again are going to be a big issue for this company. When it first happened, i.e. Facebook was really linked to some election misinformation, and then the January 6th, the response from Facebook is, we're going to hire 10,000 additional people. We're going to allocate billions of dollars of technology to root these issues out. And here we are a couple years later, and we still have these issues. So whatever they have done, it has not been enough. And I think what investors are going to want to hear, or what I think society is going to want to hear is, what else are you going to do? What more can you do?
Small stock drop right now, Paul. Thank you, sir. Down about 1.1%. Paul Sweeney coming up a little bit later. Don't miss that on Bloomberg Radio at 9 a.m. Eastern Time alongside Tom Keene. Coming up on this program, we'll catch up with Michael Nathanson on Facebook, the senior research analyst, Tom, at Moffett-Nathanson, on this stock that, as you point out, Tom, is doing okay, regardless of this broader toxic conversation.
I want to talk to Michael Nathanson, John, about what matters, which is Netflix and streaming. Paul Sweeney has been so far out front on what we're doing with streaming. What are we watching? Do we have ratings? John, we don't have ratings on this stuff.
What matters, Tom, for Facebook is ad spend. That's what I want to talk about.
Yeah, that's fair.
And the advertiser's going to look at this and say, okay, there's a problem with the data, and we didn't understand that. We weren't told. Are they going to pull back? Because John, every time, Tom, we have this conversation, the ad spend hasn't pulled back.
Okay, Lisa,
not on this anyway.
I don't want to take a lot of time here, but John, it's simple. Do you know anybody on Facebook?
I don't use it anymore.
I don't know anybody.
I think
who
it's your demo
Facebook.
now. I think that's what the story is.
Yeah, okay. Yeah, great. Quick, get my walker. I've got to go over and check into Facebook.
Lisa, do you?
No, I don't use it.
There, enough.
But honestly, I don't use Instagram either, so there you go.
So, Tom, we're going to base whether we cover a conversation based on whether you,
John,
Lisa, or I actually use the product.
John, Priya Misra spends 8 hours a day on Facebook.
Yeah, right.
She joins us now on rates and not on Facebook. Priya Misra, Global Head of Race Strategy at TD Securities. Priya, you can escape this one. It's the Fed blackout period. The chairman had the last word, the final word. What did we learn from Chairman Powell, Priya?
So I think he's managing expectations here that inflation, even though they haven't really pulled back from the talk of transitory, notice that he didn't bring it up at all. I think they're telling us that inflation, supply chain issues are going to last for a while. He didn't talk about hiking sooner, though. So I think if the market has repriced the hiking cycle significantly. And what we heard from Chair Powell, we also heard that from Secretary Yellen over the weekend, was that inflation, supply chain issues are likely to last well into 2022. So I think they're trying to tell us, look, this is going to be with us for a while. But the Fed is going to taper very soon, so we expect an announcement next week. But the hikes are still, further out, and the market is absolutely calling the Fed's bluff. I would say global interest rates are calling the central bank bluff and saying that they will be forced in to start hiking much sooner. I actually think that inflation will at some point decelerate next year. At some point, supply chain issues will go away. We think there's a lot of labor market slack, so we're actually pushing back against this move in front-end rates.
Decelerate, though, to what? And this is really the issue as you look at 10-year break-evens bumping up against the highest since 2005. This idea that people, yes, are seeing a lower inflation rate than we are seeing now, but still north of 2.5%. At what point does the Fed start to pay attention to that and actually treat that as the right way to view longer-term inflation?
Sure. So I think, we've been used to the last 20 years of much lower inflation. Maybe the next decade is going to be a 2% type inflation. Maybe we're going to be in a 2 to 3% range. I think what the Fed's going to watch for is these long-term inflation expectations, five-year break-evens. Are they looking unanchored? I think that's an extremely important aspect. And the other one's going to be wage inflation. I think the big question is, has the labor market structurally changed? Has this great resignation, is that going to remain, or are people going to come back? We feel very strongly that people who've left the labor force are going to, a lot of them are going to come back. I mean, people who've retired, maybe not, but others are going to come back. At some point, those savings are going to run out. So if wages, start to stabilize, start to head lower, at least the rate of wage inflation, I think that will give the Fed confidence that there is labor market slack. And, raising interest rates to try and solve a supply chain issue is not the solution. Raising rates to solve the labor market being tight, I think absolutely, that will be the response. Right. I think it's going to actually come down to the labor market slack or their perception.
Exactly, Priya, that's right where I wanted to go. Before you came on air, I was looking at the ECI, the blended folks' wage and benefits dynamic, and it really hasn't broken out. When you fold in your interest rate work with TD Securities, economist work, do you suggest a breakout to true nominal and even positive real wage inflation, or can you not say that?
Yeah, actually, I'm glad you bring up ECI. We prefer the ECI over the average hourly earnings because average hourly earnings is picking up. When people move jobs, they should earn a higher rate. ECI is actually looking at, if I've had the same job over the last year, have my wages gone up? So I think this whole idea of how the labor market is structurally changing, I think ECI does a much better job. We think that people are going to return. It just could take a while. People have moved. There are frictions in the labor market. At some point when people come back, that ECI is I would say, a much more comprehensive measure. We don't see wage inflation picking up at all for a while, which is why we have the first Fed rate hike only late 2023. So I think front end of the rate market globally, but particularly in the US, I think it's very attractive. I think people should move, not take duration risk. The Fed's about to taper, but move out from buying 10s into 5s, 3s. I think the Fed is a long way here from hiking interest rates.
You think we've priced too much into the belly of the curve, right?
I think so, yes. I think we've priced a lot in the front end. That end point of the hiking cycle is not moving higher. I think the market's really confused that the Fed might have to start hiking, but can the economy withstand much higher interest rates? Which is why what is surprising to me is the end point of the hiking cycle is only 1.6, 1.5. I mean, would the Fed want to start raising rates if all they can do is raise it to 1.5? That's what looks odd. So I think the belly may have a little bit more room to rise. That very front end, which is much more about the start of the hiking cycle, I think that is the most mispriced.
Priya, thank you. Priya Misra of TD Securities joining us on the rates market, pushing back against the rate hike talk. Here's another story for you, Tom. Eric Shaska helping to deliver this one. Hertz said to buy 100,000 Teslas in car rental market shakeup. That's stock up in a pre-market by 3.8%, Tom. That is a big purchase, $4.2 billion worth of Teslas.
And a huge symbol of every day becoming more of a car company. I've got to be honest, John, to me, it doesn't matter. I can't get in a Tesla. They're worse than a Camry for headroom.
That's the Tom King take on things.
My take is, I'd go to Hertz and go, I'm either walking or give me something I can get in.
Yeah, Tom, I'm not sure that's going to help Tesla this morning. Not that they need it.
You don't think the
right now.
stock's going to dip right now because
they're doing okay, Tom. Up by 3.7%, Lisa, in a pre-market.
One of the biggest aspects of this story is that Hertz will also build out the electric charging station network independent of Tesla. The idea, how can people adapt to an electric vehicle world when they don't have the charging stations to keep themselves going? This sort of providing some of the answer to that, perhaps. It also raises questions to me, John, and this is something you and I talk about a lot, this idea of what is the new model of renting cars? Is it just having a car that is autonomously driven, show up, you can go somewhere, you drop it off, and it goes to the next person? How much does this disrupt an industry and remove the need for drivers, which goes directly to what Priya Misra was talking about with the labor market?
We want to subscribe to something I will call, Tom, Mercedes Premium, where you have an app, I pay a monthly subscription.
Mercedes.
I go on there, Mercedes, someone else.
Yeah.
or Mercedes.
Yeah.
I select a car, Tom, the model that I like, and it just arrives for me tomorrow morning and it drives me to work. That's the perfect setup for me, TK. $500 a month. Let's just call it $500 a month and 10,000 miles worth of travel through the year.
You know, John, I mean, I'm trying to look on the New York State electric vehicle charging stations map. Yeah. And I've never looked at the map below 59th Street, and I'm doing that now. And, you know, there's a fair number of charging stations down where the fancy people like you live. There's exactly 2 charging stations in Soho, south of Houston Street.
Where's that?
Houston Street?
I
They
don't
named
know.
it after the Astros.
Is that right? Why would you tell people where I live?
No, I'm not. You know, you live, John lives, folks, like 42 blocks in a concentric circle.
Is that right?
There's hardly
Thanks,
any
Tom.
charging stations down there.
Thank you, TK. Tom Keene, Lisa Bravitz and Jonathan Farrow. I
How
give
about
up
those
with
markets?
you. And honestly, more than those markets. Up a 10th on the S&P, all-time highs on the S&P 500 through much of last week.
There's a charging station near Goldman Sachs.
Is that right?
Yeah.
Do I live next door to there too?
No, you don't live
Why don't you
next-
just give them a door number, Tom? Tell them the
I wouldn't
apartment
do
too.
that.
That's good. You respect my privacy. That means a lot. This is Bloomberg.
With the First Word News, I'm Laura Wright. China is warning that new COVID-19 infections will increase in the coming days after the latest outbreak, which is fueled by the Delta variant, expanded to 11 provinces. It locked down hundreds of thousands of people in the north, asking them to stay home. Officials are warning of civil and criminal penalties for anyone disobeying the order. UK Chancellor Rishi Sunak is set to announce almost £6 billion for the National Health Service at this week's government budget. The boost, as the UK attempts to clear backlogs caused by the pandemic, is one of a few major giveaways likely in Wednesday's financial statement. Sunak's task is complicated by a stuttering economic recovery, faster inflation, and a surge in virus cases. Turkey's lira fell to a record today amid the country's ongoing diplomatic spat. Already under pressure following a larger than expected rate cut last week, the currency slid again after President Erdogan said the ambassadors of 10 nations, including the US, Germany, and France, were no longer welcome. The countries are demanding the release of a prominent businessman and philanthropist. PayPal says it is not pursuing an acquisition of Pinterest, ending days of speculation over a potential $45 billion deal. Last week, Bloomberg News reported PayPal had approached Pinterest about a potential deal. An acquisition of Pinterest, a visual search and scrapbooking platform, would have boosted PayPal's ambitions to become the next global super app. Global News 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
We are going through a period of inflation that's higher than Americans have seen in a long time, but we haven't lost control. I expect these bottlenecks to subside. Americans will return to the labor force as conditions improve.
The Treasury Secretary, Janet Yellen, there speaking on CNN. From New York City this morning, Tom Keene, Lisa Bravitz and Jonathan Farrow. Your equity market up 6 on the S&P. We advance a little bit, a little more than 0.1%. In the bond market, yields are higher by 2 or 3 basis points to 166. Tom Keene, this administration having a conversation it doesn't want to have. And that's a win for the Republicans. Every time they go on air right now in the United States, on broadcast television, on the radio, in print, it's a conversation about one thing, Tom. It's inflation. And that's exactly the conversation the Republican Party want them to be having.
Absolutely, and you see it linked right into what we talked about before, John, as a gallon of gas. Let's just go through it really quickly here. Any number of ways to measure this, but the key way to measure it is it's different in each city. In the Houston, the land of the Houston Astros, they play the Boston Braves coming up. But in Houston, it's $2 something a gallon. In San Francisco, it's $4 something a gallon. John, those are real numbers.
Neil Dutta of Renmac, picking up on the tone, the shift in the tone, said this about Chairman Powell on Friday. Powell sounded less anxious about employment and more anxious about inflation. He is not really leaning against the market pricing, which is revealing in and of itself. The take there, Tom, of Neil Dutta of Renaissance Macro.
Well, it's about the market pricing here, and the market pricing can be in politics as well. Let's get to it, because we're going to get to Turkey here in a moment. Anne-Marie Horton joins us, our Bloomberg Washington correspondent. Anne-Marie, Greg Valliere with a scathing essay this morning on, I believe it was 7 reasons why the billionaire tax will go down in flames like every other tax as well. How likely is it we will see a billionaire or a millionaire tax?
Yeah, Greg Valliere really scathing and also bringing up some points that, one, potentially this is going to face constitutional challenges, and also how do you have a value for things like someone who has a coin collection or Monet, and also what happens if those values go down? Do you get taxes back? We just don't know yet the plans of this. They are still discussing it. But what we do know is that Senator Kyrsten Sinema is not on board with the original proposal to fund this entire social spending plan, which was the corporate rate and income rate, increasing those rates on taxes. So they're looking in this billionaires potentially or mega millionaires tax, about 700 people this would be focused on, but there's still so many questions. So it does feel like there's a little bit of progress in terms of the talk, but it's going to be a while to see pen to paper. This is a tax that has not been vetted and something that has not been done anywhere else in the world. So to get it done in a matter of days, I'm going to be cynical, just seems impossible.
That number, though, Anne-Marie, Tom, let's not let that slide. The number 700. This is really, really important. Tom, when you hear people on the left, people in the Democrat Party, talk about billionaires, it's as if there are cities of them. There are 700 billionaires in the United States of America. A lot of people are criticizing this effort now to tax unrealized capital gains. And Tom, I think it's important to recognize one thing. The goal was to get billionaires, 700 of them in the United States of America, to pay more in taxes. This is the first time that we've had a big effort this year to reconcile the objective with policy. Because, Tom, I keep hearing, let's go after the billionaires. Then simultaneously, I hear, let's tax people earning more than 400K. Now, Tom, if you want to go after the so-called billionaires, doing it through income taxes doesn't get it done. And that's what's intriguing to me, Tom, about this moment. There are only 700 billionaires in the United States of America, according to, say, Forbes. If you want to go after them, these are the difficult conversations we've got to have.
And I thought of Samuel Bowles in a definitive book that we had a decade ago, I'll say, out of Princeton, Samuel Bowles on microeconomics, behavior in taxes. Anne-Marie, what's the behavior here? How desperate is the Democratic leadership?
Incredibly desperate to get this bill passed. Quickly, a note from what Jonathan is saying is ProPublica did an entire report on this, looking at a vast amount of IRS data over the summer, and you have the likes of Jeff Bezos, 2007, 2011, no income tax rates. And that is what the likes of Senator Warren and Senator Ron Wyden, the chair of the Senate Finance Committee, who's going to be drafting this proposal, is trying to get out. This isn't about the entire country obviously paying its fair share. It's really about those that are escaping those income tax rates. And if they are, how do you go after that unrealized capital gains? When it comes to the Democrats trying to push this through, you saw them working over the entire weekend. The notice we have this morning, and CNN is reporting that Senator Joe Manchin has been able to come up and he's lifted his line in the sand for that top line figure from 1.5 to 1.75. So potentially a $250 billion lunch the president was able to get over the weekend, but there's still a number of issues at play here. But it's a critical week because, of course, the president wants something before he goes to Europe, and then when he comes back, he faces 2 important governor races in Virginia and New Jersey as well for the Democrat Party.
Anne-Marie, how much is this turning a talking point into policy versus just getting enough of an agreement to get the fiscal infrastructure plan to a vote?
It's a bit of both. A framework, definitely they want to get done before October 31st. This is that soft, self-imposed deadline. It's also when the highway funding runs out, so they want to be able to have those billions of dollars instead of just doing a separate stopgap funding measure to extend that funding to actually just pass the bipartisan infrastructure. Also, they want this win. They want to be able to go campaign in Virginia, campaign in New Jersey, and help those Democrats and say, look, we are moving forward. Bipartisan infrastructure infrastructure, what they call the BIF here in Washington, D.C., has wide bipartisan support. But is a framework, it's a good question, enough to get through? Potentially it could be. But there's still, as I say, tons of questions. Okay, if you get Manchin and you get Sinema on board with this new tax proposal, what happens when it comes to Medicare as well? The president at the CNN town hall in Baltimore said that that doesn't look like it's going to be this expansion of vision, dental, and hearing that many of the progressives wanted. What happens to the likes of Senator Bernie Sanders? Every single individual, the basic needs of all these senators need to be met in order to get some sort of framework agreed upon.
Anne-Marie, thank you. As always, Anne-Marie Horton down in D.C. Tom, this topic is really, really difficult. It's complex, and it's more complex than the conversation in Washington would suggest. It's not just about taxing the rich. Who are the rich? It's not about paying your fair share. What is fair? Most people, Tom, who are salaried and earn over 400K are probably paying close to 50% tax all in, income, state, local. What's fair, Tom? 50%? And if we're talking about the billionaires, the so-called billionaires, then we need to talk about how many there are in this country, Tom. There are about 700 billionaires in the United States of America. So, okay, if we're going to do something about the 700, what are the policies that will extract more tax from those 700 people? And, Tom, it's not a push-up in the higher rate of income tax, is it? It's something else.
Well, it doesn't. The bottom line, as Villiers mentions, it doesn't raise enough. But, John, let's take it to the ultimate billionaire. The Queen Mother died, and Queen Elizabeth escaped all sorts of tax, I'm sure through proper British law and fancy lawyers and fancy trust. I mean, it's an ageless thing for people with a pot of money.
And, Tom, as you point out, there is a big difference between evasion and avoidance. One is illegal and one is perfectly legal. And if you want them to pay more in taxes, then by all means change the rules. But just pushing up the income tax thresholds, Tom, that's not what gets it done.
What I see here is desperation and a lot of unintended
You're not the only one.
consequences down the road.
You're not the only one. Tom Keene, Lisa Bramett and Jonathan Ferro from New York City this morning. Good morning to you all on radio, on TV, kicking off a new trading week. This is Bloomberg.
Engine number one was able to do on the Exxon fight, it opened a lot of people's eyes to, I guess, the power that smaller investors can have. And I'm curious as to how other people can sort of look at what you did and use that is either a template or maybe just some sort of guide as to how they can sort of approach their relationships with other companies.
We founded the company in Engine Number One on the idea that we take the data, not ratings and rankings of ESG of the past, but we actually take the environmental, the climate, the social, worker data, and we simply use it to look at the valuation of companies and look at it over a long period of time. And so if you think about it that way, you own these companies. Everybody that owns the company, whether you're a big institutional investor or you're a small retail investor, you own the company. You have a voice, you have a vote every year.
Yeah.
And so our approach is, is to use the vote and engage with these companies over time.
But that's always been the case. I mean, at least in theory.
Countries, Francine, that are the equivalent, that equal 80% of all the emissions. Those 20 countries, above all, have to step up.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Just pulling back from all-time highs at a close on Friday, breaking that 7-day winning streak on the S&P 500. This morning, back at it, a lift up 5 on the S&P, advancing a little more than 0.1%. On the Nasdaq, advancing about 35, call it 36. We're higher there by 0.25%. The Russell, the small caps, unchanged, Tom. Looking ahead to a week full of tech earnings. Setting the stage in the bond market for next week. Next week, what a week we've got coming up for you. Chairman Powell and a Fed decision on the Wednesday. Then it's payrolls on the Friday. Going into this 165.90 on a 10-year, we pull back from 170 in Friday's session. Yields higher again, though, by 3 basis points on 10s, on 30s, up by 3 to 2.1%. It's that 2-year segment of the curve I want to talk about, 46 basis points right now. And here's the chart over the last year. If you took the chart of the 2-year yield over the last 5 years, we've barely taken a bite out of things. And Tom, over the last 2 years, say, at the moment, this is what it looks like at the moment. We've got a lift, but we're nowhere near where we were going into the pandemic because we had to cut rates so aggressively. What's interesting about this pickup in the 2-year, Tom, is the degree of pushback we got from Chairman Powell on Friday. Not much. In the words of Neil Dutter of Renmac, not much at all. The focus seems to be a little bit more anxiousness on inflation and less on employment. And Tom, if that's the story coming from the likes of Neil Dutter, you wonder what that means for the news conference next week, Tom. Just how aggressively will they push back against rate pricing?
I've said this all morning, John. They're going to wait for more data. And to get to the news conference, John, they've got to see that data.
They will get some more data, Tom, the Friday after the decision. Payroll's just around the corner.
That's a little difficult. We will see. And that's a very, those of you on radio, the chart that John had was really extraordinary to show what the normal was in the 2-year yield that we remember. Amy Wu Silverman is equity derivative strategist at RBC Capital Markets. All you need to know is her research notes are really sophisticated and have loads of Greek letters. She looks at the cross moments, skew, kurtosis, and the rest of it, and distills it down to shut up and hold, or shut up and buy, or maybe go to cash. She joins this morning. Amy Wu on rate of change and on delta, not the convexity, not the second derivative. You are all first derivative this earnings week. Why?
Oh, look, this is really the week the market reports, right? So, you basically have the big mega cap tech FANG names, and those 5 names really make up 20% of the S&P. So the folks who are using options right now, Tom, particularly for this Friday's weekly expiration, what are they playing? They're either trying to hedge, this movement in tech, which could result in a movement in the market, or they're doing it individually, but these mega cap names are really driving the market overall because of their size.
I want to give our audiences on radio and television, Amy, the idea here of what is in your research notes. Let's take Apple. We could take any other name, folks. And I want to talk about the delta, the rate of change, and also what you see in the cross moments. Take Apple now, and if somebody wants to go long or somebody wants to hedge their long, how rich is the derivatives market of Apple? And folks, just to be clear, Delta is not an airline.
Well, it is an airline, but in the context of options, it's also the sensitivity of option price to changes in the stock price. And obviously, that's what we're looking for, especially when there's an event, Tom, Surprisingly, Apple options are not that expensive. We compare it to all its comps that are reporting. We compare it to the market. We compare it to its own realized volatility over time. And heading into this earnings, Apple options are fairly inexpensive. And the other thing is the amount of demand for hedges is actually declining. Which we think is interesting, given that it was kind of at the center of the storm around the privacy issues that obviously bled into Snap and into other tech names that we saw last week.
So, Amy, taking a step back, does that mean that people are pretty optimistic heading into these tech earnings, that basically they think that a lot of the bad news and the potential discrepancies that have stemming from some of the supply chain disruptions have all been priced in?
Yeah, when we look to the options market, that was one of my takeaways, in particular after last week. I'll give you one example. Snap obviously down, 26% on earnings, but if you actually look to the derivatives market, it has now gone into skew inversion. Just to translate that means the demand for calls is now outweighing the demand for puts. That's a fairly abnormal event that doesn't always happen in options, and it's signaling kind of an extreme level of bullishness. We're also seeing that in Facebook as well. We're seeing that in Apple. So, look, people can be wrong in the options market just as they are in the stock market, but the sentiment is certainly shifting more bullish ahead of this week.
Amy, one of the wonderful things that you do is you track the correlations and try to understand what the triggers are. And here we are heading into tech earnings at a time when there's increasing bearishness around bonds, right, around duration. And typically tech has been viewed as the most duration heavy area. How do you view the correlation with people's view on the rates market with tech sentiment at a time when they've been posting blockbuster earnings?
Yeah, it's a great question. And obviously kind of also the 10,000 foot view related to that is that tech is kind of at the center of this growth versus value trade, just as it is compared to bonds as well. I'll say one thing right now, correlations will tend to break down a little simply because we're going into earnings, which tends to be an extremely idiosyncratic event. So if there was any time for that dispersion to appear in the market, it would be now. But I do think that as we head back into year end, that becomes something that people watch very closely, just where tech is compared to the bond-related ETFs like a TLT, a HYG, and LQD.
Can you do a derivative analysis of a moonshot? Up we went above 800, down we went on Tesla, and now up through 951 this morning on the Schatzker article. I should notice Mr. Jonas at Morgan Stanley raising his price target as well. Can you, Amy Wu Silverman, do a Greek letter analysis of something as original as Tesla?
I love Tesla from an options perspective, and the reason is it's just become its own special animal. We have 500 to 1,000 stocks that we watch all the time, Tom, and occasionally we just have to put Tesla in its own special bucket. One thing I'll tell you on Tesla right now, it's equity skew, one of your favorite words, that demand for put protection had been really, really high. It dropped a little bit after earnings, but what I think is interesting is it's still pretty high, and earnings are over, right? So what is the market kind of concerned about on Tesla? Just before I started this call with you, we saw the Hertz announcement on Tesla, so maybe that changes today.
Yeah, thank you to Eric Schatzker for that reporting. And Amy, what's so important here, and folks, I don't want to get too in the weeds here, but if you have a continued hedge value to Tesla, at some point up, they have to cover. Is there a convexity opportunity in Tesla where we see an acceleration higher as busted trades are covered?
Yep. So you're referring to kind of what people refer to as the gamma hammer or the gamma squeeze, where a lot of the times when you see that inversion in skew, right, that call demand again outweighing that put demand, it forces dealers who are doing delta hedges on the other side, because dealers are trying to not take directional bets, right? They're trying to not take bets on delta. They're simply trying to facilitate people on both sides. If there's extreme call buying, you can essentially see more stock up situations because of that Greek letter gamma, that gamma squeeze that's happening in Tesla.
Before we let you go, Amy, I'd love to get a gauge of just how active traders have been going into the earnings season. The idea that we've gotten so many of the gains, that the year is almost over, especially as people recalibrate their expectations for Fed policy. How much is activity increasing as there's this idea that this is the last hurrah, this week of earnings, before people basically pack up their bags and go on vacation?
Yeah, we've seen a lot of institutional activity. We've seen a lot of hedging in QQQs ahead of this week. I think a lot of that is related to just simply how large a market cap is reporting in this week alone. Obviously, we see the traditional year-end hedging, but, we have seen a drop-off, Lisa, in retail demand. So, retail, which was busy trading call options to kind of insane degrees last year during the pandemic, that's dropped off a lot. I think they're busy trading cryptocurrencies now, but, that activity has lessened much more than it was at this point last year.
Amy, thank you. As always, Amy Wu-Silverman there, the wonderful Amy Wu-Silverman of RBC Capital Markets on a big week for big tech. You know what the quiet tech name is right now, Tom? Microsoft, up by 39% year to date and barely gets a look in anymore. What a run.
Yeah, well, it's been a run, and some do it 1 year, and then they pause, and they do it another year. But, John, I think what's so important is the people we talk to looking at 3, 4, 5 years. Even Doug Cass, who's trading partitions out to an enthusiasm out 3 or, 5 years as well. John, I can't say enough about bringing Amy Wu-Silverman on, truly talking Greek, and the value that is for global Wall Street. Some of the stuff she was talking about there is nicely inside baseball.
Totally agree, Tom. And she mentioned how much she liked Tesla, so let's talk about that a little bit more.
Sure.
Up 4% in the pre-market. Great story from our colleague Eric Schatzker. The lead paragraph reading as follows. Hertz, barely 4 months out of bankruptcy, placed an order for 100,000 Teslas in the first step of an ambitious plan to electrify its rental car fleet. This according to people with knowledge of the matter. Lisa, that's a $4.2 billion price tag, according to the story.
It's the biggest single purchase of electric vehicles ever. And the idea that Hertz, barely out of bankruptcy, I like how you phrase that, John. The idea that they get some money, and what do? They make a bold investment, and frankly, investors celebrate that. That, to me, is interesting. The idea that people are looking for bold at a time when money is free.
John, how does General Motors or Porsche or the others, how do they respond?
Well, clearly, Tom, they're working on it right now. We talked about the Taycan, didn't we? That Porsche offering, Tom. Yeah. Outselling the 911. So it's happening. It's happening. We've talked about the multiple on, say, GM, Ford. We've been talking about that together over the last week. Those two names have had a great run this week, so much so that we're now discussing the likes of Dan Ives of Wedbush covering these names, Tom. Not just Tesla, but the likes of Ford, the likes of GM.
Yeah, well, they are. And, I'm looking at right now, I've got a closing market cap on Tesla of under $1 trillion. John, we may be over $1 trillion by the end of the day.
We could be there, Tom.
We could.
9:45.55 in a pre-market. Coming up on Facebook a little bit later, Michael Nathanson, the founding partner and senior research analyst at Moffett-Nathanson. We're up 0.1% on the S&P. From New York, this is Bloomberg.
With the First Word News, I'm Laura Wright. West Virginia Democratic Senator Joe Manchin appears to be on board with White House proposals for new taxes on billionaires and certain corporations to help pay for President Biden's scaled-back social services and climate change package. CNN is reporting Manchin is okay with a $1.75 trillion package. That follows a meeting on Sunday between President Biden, Manchin, and Senate Majority Leader Chuck Schumer at the president's home in Delaware. U.S. labor shortages will persist into 2022 and contribute to a permanent increase in business costs. That's according to the latest survey by the National Association for Business Economics. Some 36% of respondents currently experiencing worker shortages said they expect them to end at some point next year. None see it happening before the end of 2021. 14% see shortages abating in 2023 or later. A big move for car rental company Hertz, which is barely 4 months out of bankruptcy. Bloomberg has learned Hertz has placed an order for 100,000 Teslas. It's reportedly the first step of an ambitious plan to electrify its rental car fleet. Sources tell Bloomberg it's the single largest purchase ever for electric vehicles and amounts to about $4.2 billion of revenue for Tesla. HSBC is outlining a bullish outlook for the months ahead, fueled by likely increases in interest rates. The London-based lender also said it will kick off a higher-than-expected share buyback program. Adjusted pre-tax profit rose to about $6 billion in the third quarter, beating estimates. Revenue climbed slightly in the third quarter for the first time in almost 2 years. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
So if someone wants a leader, is it better to find a general or an admiral?
That's like asking me to say, who do you love more, your son or your daughter?
The energy crisis, there's a lack of drivers. Is there anything that you need to ask authorities to do better, or that your clients want the UK to do better?
I think we're at a moment in time where we're coming out of the pandemic and there are a handful of things going on. I think all over the world there are labor issues that are really a reflection of this transition out of the pandemic. There are supply chain issues. Some of this stuff is transitory. There are some secular trends that we have to watch closely. But I think we're adjusting and dealing with it as anybody else is. And I think leaders here are thinking about it the same way leaders are around the world.
When you look at the UK and, of course, some of these green investments that the UK and the City of London particularly has been really trying to pitch, you've been extremely involved in carbon offsetting. Can London really spearhead that movement?
Well, I think it's important that governments around the world partner with the private sector to try to get capital directed toward innovation in a way that we can accelerate the climate transition. And I want to emphasize it's clearly a transition.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
You talk about hiring aggressively at the moment. Can you walk me through how challenging that is at the moment? How difficult is it to find the right people?
Well, things have changed. Again, the world has changed under the pandemic, and you all know worldwide, what the challenges with getting people back into the workforce.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This dance between what officials at the central bank want to see happen and what the market wants to see happen. And sometimes they are perfectly in a line, like they were earlier this year about transitory inflation, and sometimes they're not. And that might be what we're seeing right now.
We've seen this movie before, a little bit of tension between what the market is pricing and the guidance from the chairman of the Federal Reserve, Jay Powell. Jim Bianco there of Bianco Research. Tom Keene, Lisa Abramovitz and Jonathan Ferro. Your equity market up 5 on the S&P. Futures advancing about 1/10%. Into the bond market, yields high, yields lower on Friday, pulling back from 170. We add a little bit of weight to the 10-year yield, 165.19. Yields up 2 basis points. In line with that move, Tom, crude heading north again, up by 1.24%. WTI 84.80. And Brent crude, Tom, where's that now?
Up 1%, 86.43.
We
That's closer to 90 than 80.
There we go. We add another 90 cents to Brent crude, Tom.
Very good. Right now, we're going to do this. We're going to talk to David Wilson quickly about the former president and then the important reporting of Eric Schatzker on Tesla and the rest. David Wilson, what do you have this morning?
I have Donald Trump's meme world, Tom, and I say that because you had this deal last week from a special purpose acquisition company, SPAC, Digital World Acquisition, to take over this, shall we say, fledgling media business. And you really saw the shares take off on Thursday and Friday. But it wasn't just Digital World. I mean, you have this other company called Funware that had actually worked for Trump's re-election campaign in 2020, a software maker, and its shares were up even more. And then you look at other SPACs tied into the CEO of Digital World, and you see they were rising as well. One of them, Benasir Capital, is actually higher again today. And then he's the CEO of that company as well as Digital World. And then there's Yunhong International, which he also runs, and Makia Capital, where he's the director. Put it all together, and it's not just one meme stock, it's 5 coming out of this single deal.
Very good. David Wilson, thank you so much. Greatly appreciated this morning. It has been important reporting on too many levels. What we're going to do is not review the reporting of Eric Schatzker on Tesla, on Hertz, and the rest, but we're going to drive forward the story with Mr. Schatzker's knowledge here of electric vehicles. First, Eric, congratulations on this reporting. And what I want to know, I calculate $1,000 a share on Tesla to $1 trillion company. What kind of $1 trillion company will Tesla be?
Well, to the degree, Tom, that more rental car companies, because it's not just going to be Hertz, eventually Enterprise, eventually Avis, eventually Sixt, eventually maybe not Europcar because they're owned by Volkswagen, but they're all going to move toward EVs. So if you believe the EV revolution and you believe that Hertz, by ordering 100,000 Teslas, is changing the game for the rental car industry, then I'm not going to put a valuation on Tesla, but you know there's more demand behind this. Let's put it that way.
Eric, how instrumental is it for other companies to build out the electric network? I mean, that was part of this announcement. The idea, or part of your reporting, was that Hertz would independently invest in those charging stations that are key to having Tesla be more mainstream.
Sure. Hertz has to build its own network of chargers because you can't take a rental car and have to drive it to a Tesla supercharger in order to have it ready for the next customer. The question, sort of the implicit question embedded in what you asked, is whether these chargers that Hertz is building are going to become part of a nationwide, at least here in the United States, and maybe even broader continental in North America, something similar happening in Europe, network available to other users, let's say. Maybe they're not Hertz customers, maybe they're not even necessarily Tesla owners, but there are more and more companies coming out with EVs. We know that Ford has an ambitious plan for its pickup truck, the F-150. Clearly, General Motors, an early player in EVs, nowhere near as big as Tesla, has ambitious plans. Volkswagen, Porsche, they're all moving in the same direction. And eventually, in theory, people are going to have access to chargers the same way they have access to multiple brands of gasoline.
So Hertz just emerged from bankruptcy. Where do they get the money for this?
Well, Hertz is doing awfully well, actually. They've got $1.8 billion in cash on the balance sheet. The rental car industry has turned around dramatically since May of 2020 when Hertz filed for bankruptcy. Back then, as you'll recall, there was no demand. It evaporated. Business travel was gone. Leisure travel was gone. Hertz had a bad balance sheet. A legacy of its leveraged buyout, was the first to go. Avis didn't file for bankruptcy. Enterprise didn't file for bankruptcy. But bankruptcy, as we know, can be a beautifully cleansing process. So now Hertz is shorn of so much of the debt that it was carrying. It's a much more nimble company. It has new ownership in Knighthead and Certares. It has Mark Fields, the former CEO of Ford, as its interim CEO. This is an illustration of what a newly empowered company can do in an old commoditized industry.
Eric, you and I know Vivi Chara can't get in a Tesla. I'm here to inform you Frank Mahavlich can't get in a Tesla either at 6'1" or a tall 6'2".
Oh, he could get into a Model X.
He get it, but that's the point. What's the EV car that's actually going to be that first American car, not a car of the elite?
It's the Model 3. That's why Hertz is ordering 100,000 Tesla Model 3s. This is the EV equivalent of, let's call it the Chevy Impala. It's a much nicer car to drive than the Chevy Impala.
So what's Mari Barr doing this morning? Cut to the chase here. What's she doing?
She's figuring out what is GM's strategy for that middle of the market. Right now, GM is playing with a Chevy Bolt at the bottom of the market, and it's designing some really exciting stuff at the top end of the market.
Where's the middle
in the Cadillacs.
car?
They don't have one. That's why the only place that Hertz can go for 100,000 EVs is Tesla. They're the only company with the capacity and the only company with the car.
John Schatzker's here. I got to ask one more question. Fabulous news out of Canada this weekend that they're saying COVID's done. What did Canada do different than the United States?
We opened up faster here. I was just there, Tom. Toronto feels like it's 3 months behind the United States, 3 months behind New York City.
Really?
Yeah, but I'm not so sure. So we can talk about a COVID score. Canada is clearly doing better. Ontario has only 325 cases a week of COVID. But look at the economy. The economy is not... Life in Canada has not returned nearly as much back to normal as it has here. And that, of course, is what is the balance we're trying to weigh.
John, we got to leave it here for two reasons. One, we're running out of time. And two, do you know Schatzker had Kawa's tickets at the Garden?
One is important, Tom. Two less so. Eric, thank you. Great story, sir.
Yeah,
fantastic reporting. Absolutely brilliant.
Thank you,
the stock is up by a little more than 4%. So off the back of Eric's story, Tom, we stand down a $1 trillion market cap. And we discussed this on Friday, didn't we? We have the real prospect of a $1 trillion market cap in the equity and junk rated in the credit.
Yeah, and I'm
Square that one for me.
Yeah, well, you're right. You've brought that up a couple times when you look at the debt structure and all. But John, I think what's so important here in the industry is to say when you're wrong. I was wrong on Tesla. Schatzker was right. Winkler was right. Who else was right, John? Were you right, John? I don't know.
I was dead wrong.
I was dead wrong. I'm sorry. 940. Schatzker drives the stock to 950 with the story, and I fitted it. It's about $1,000, give or take $1.
4.3%.
I'm looking for an entry point at 1,100.
Keeps getting it done. Tom Keane, Lisa Bramlett, Jonathan Ferro. You keep looking, Tom.
John, you don't know who
TK,
Frank
that entry point
is, do you?
Yeah, I think he's an ice hockey player, isn't
That's
he?
good. You nailed that.
Cheers,
Nailed
TK. And that was just a guess. What's the
John,
big sport in Canada?
You need a CCM 5 strike. That's what we need to get you.
No, I'm lost. Yields up 2 basis points on 10s, 165.19. Equity futures up a little more than 0.1%. From New York, this is Bloomberg.
They don't know what to say. Again, they can't even fathom that they're out of Afghanistan. They're still in a state of shock and can't believe it.
What we have built through this process is essentially a mechanism for getting oppressed women and girls out of Afghanistan. So we're actually going to circle up and see what resources we have left, to see what options we have left, what mechanisms we have left, and actually look at potentially trying to get more women and girls out of the country as well.
We've been through a lot, us as a team. I know sleepless nights, but you know what? There's nothing more satisfying than knowing that you've saved many lives, and will continue to support these girls on their mission.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
From New York City.
We're in London, in Sydney,
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
So recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
There's this dance between what officials at the central bank want to see happen and what the market wants to see happen.
Yes, inflation is a focus, but the market has priced a good amount of that.
The market is essentially fading the Fed's inflation and maximum employment strategy.
The consumer is able to bear a little bit of this price pressure, but I do think that there is a limit to this.
If you can't meet demand, why would you advertise? Just cut your ad spending.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Thrilled you're with us on radio, on TV. Later in the hour on $86 a barrel oil, Ms. Wald will join us. That's going to be an important conversation, looking at equities, looking at earnings. And for global Wall Street, in a few minutes, we consider the break-evens, the sophisticated part of judging inflation to the yield market and how it folds into everything else we do. Good morning, everyone. John Farrow, I just said there, sort of the landscape. What are you focused on in that landscape?
This week, tech earnings, and the words from Jonathan Golub, Credit Suisse there, Tom. If you can't meet demand, why advertise? Cut ad spend. What a phenomenal line there from Jonathan Golub, reflected in the earnings of Snapchat, and maybe reflected in the numbers we see later this week from the likes of Alphabet, the likes of Facebook as well. And then, Tom, it's on to Apple. Apple on October 28th. Are those supply chain difficulties really holding back their ability to meet that iPhone demand?
No, we're seeing it. You're seeing it all over the world right now. We will fold that in again to the lack of. There's a lack of Fed speak now, right, John? Last week we had 6 people in a day, and now we have nothing.
This is the week where people are very grateful, happy that we get no Fed speak whatsoever for a whole week, Tom. Then it's on to Chairman Powell, November 3rd, decision news conference.
Yeah, Lisa's got that bumper sticker by her desk. Put a cork in it, Jerome. Good morning, Lisa. In Washington right now, it's really. Do you like that, Lisa? In Washington right now. It's extraordinary. I mean, I have no idea what they're going to do besides tax you and the rest of the billionaires.
Well, there's the issue with respect to fiscal stimulus, fiscal spending. There's also the question, though, of next week with Jerome Powell. How much have we calculated what tapering looks like? And how much do we understand what bond purchases have done to a market that is can't seem to go down too much? Tom, I do think that this will increasingly be the debate as Jay Powell tries to divorce the conversation from taper to rate hiking.
from what you've read, Lisa, are we going to get tax legislation? I can't figure it out.
I can't understand how realistic they're trying to get policy versus a talking point they can all coalesce around. I mean, honestly, the idea of what is the threshold to finally vote on the infrastructure plan that everyone agrees upon. To me, I don't even understand that, Tom.
I don't understand Liverpool, Man U. John Farrow, the gentleman from Britain, talked about 700 souls, 700 lads are billionaires. I mean, John, the desperation in Washington is extraordinary.
Is it desperation, though, Tom, or finally a realization that we need to have a difficult conversation about how to get more tax from billionaires and how many billionaires there actually are?
Yeah.
There's about 700 of them in America. Let's have a conversation about how to get more tax.
Yeah.
Tom, we've finally got to that point where I think the facade of the argument starts to break down. Tax the rich. Who are they? Make sure they pay their fair share. What is fair? We need to have a real conversation about that,
It's
Tom.
not
I don't
happening.
think we just haven't had that enough this year.
We're taxing Monets, as was brought up by Greg Vallier. John, let's do the data check right now because our guest this morning is so important on inflation dynamics. Futures up 7. John, the VIX 15.84. I would actually look for that to be a bit lower. It's not.
The yield's up 2 basis points, 165.37, and crude WTI approaching 85, 84, 86. 86 on Brent, Tom.
$2, 86.47, up 1.1%. West Texas up 1.3%. And John, in the metals complex, I know it pulled back, but I'm sorry, it is commodities elevated.
Just a lift across the board. Let's get to our first guest for this hour. Shahid Ladha joins us now, head of G10 rate strategy at BNP Paribas. Shahid, let's start right here. The amount of daylight at the moment between the guidance we're getting from the chairman of the Federal Reserve and what's been priced in this rates market.
Sure. Thank you, John. Look, I think that the Powell and the Fed are increasingly open to the prospect of perhaps a quicker hiking and tightening cycle than many thought possible even some months ago. The lack of pushback late last week from Powell, I think, underlines this. And markets are now, as we know, pricing a little around 2 rate hikes next year. And there should be 4 live meetings from July through to December. So perhaps we could price as much as 4 or even not necessarily just 25 basis point rate hikes.
Shahid, do you think a meeting next summer could be a live one? The Bank of England has indicated that next week's meeting is a live one for the Bank of England. Do you think for the Federal Reserve that first live meeting for rate hikes could come as soon as the summer next year?
Absolutely. I think every meeting after that next year could stay live. And as I said, we've been more and more conditioned to expect a very slow hiking cycle. But if inflation really is somewhat different this time, then perhaps the Fed needs to move quicker. So like I said, we could get bigger increments or more frequency in 25 basis point hike delivery.
Shahid, before we get there, the Fed is going to start tapering their bond purchases. And I'm unclear on just how much agreement there is on the influence that the $120 billion of bond purchases have had on the $20 trillion U.S. bond market. What's your sense of the influence and thus the effect of withdrawing some of that?
Sure. So that's a big question. When you look at 2020, the influence was very, very clear because there was so much QE and net supply, despite the explosion of the deficit with pandemic-related stimulus. Net supply of treasuries was negative in 2020. So it had a massive impact in 2020. Since then, there has been an impact, but that impact has moderated as the flow of QE has normalized to about 80 billion a month on treasuries, 40 billion a month on MBS. And in the meantime, treasury supply has increased from about 230 to about 370 billion a month. So in other words, the Fed remains the largest buyer of treasuries right now, but some degree of kind of almost coordinated stimulus and what seems like a coordinated exit from stimulus should make the path of net bond supply to the market, the paper that the market needs to buy, relatively smooth. I say that because as the Fed reduces its footprint buying treasuries, the Treasury will reduce its deficit next year. We think somewhere in the region of $1.5 trillion. That's half the size of this year.
So, Shahid, do you expect real yields to remain as negative as they are now in the United States, despite the tapering?
We think they are a little too low still. So our kind of post-COVID new normal would be nominal rates, somewhere at the recent new normal, so somewhere 10 years around 2%. We do think break-evens and inflation should be about 50 basis points higher, so that takes us to 230 or 240. And the resulting real yield is about minus 50 or minus 60. So we certainly think that real yields are a little too low right now. Spot at minus 5.5%, which is just spot real Fed funds because of high spot inflation. And 10-year at minus 1% likewise is a bit too low. But we do think they stay lower post-COVID than they were pre-COVID.
Shahid, very important question here. We addressed this earlier. Let's do it with you right now. Is there a convexity in the market? Is there so much of a bet a certain direction that if that bet has to go, oops, I'm wrong, I have to cover, boom, up we go higher in yield?
There is a degree of that as we break through certain key levels with major exposures for certain types of accounts. But what we have seen, despite the level of realized vol, which has been pretty high in the past month or so as we've moved to higher rates, the forwards now remain pretty well pegged. 5-year OIS in the region of about 180, 10-year in the region of about 170. And even the 30-year rate, yes, it's jumping every day, but it's been somewhere between 2 or 220. So there is the possibility of convexity if we move out of the range and materially so. But even if we move a lot within the range, which is currently what's been happening since we got above 150 on 10s, really, then the convexity is limited.
Shahid, what do we get first? The rate hike from the Fed or a new manager at Manchester United?
I hope for a rate hike first.
As a Liverpool fan, I wonder why. Mr.
Solskjaer's doing a great job.
You want them to suffer, don't you? Shahid, great to catch up, sir. Thank you. Shahid Ladha there, the BNP Paribas rate strategist. Tom, just getting some confirmation from Hertz on the reporting that Eric Schatz has been doing on the 100,000 Tesla order that Hertz has delivered. They confirmed that order for Tesla, 100,000 Teslas by the end of 22. And you'll like this little piece of it, won't you? They confirm a deal to hire Tom Brady to showcase Tesla ads at Hertz.
Yeah, and it's going to be interesting. As Schatzker said, it's a Model 3. It's got better headroom than the Model X and the rest of them as well. But Brady's 6'4", which, I mean, John, I'm either 6'4".
How tall are you, Tom?
I'm 6'4" or 6'5", depending on if my children need money. So
I
this
think you're
morning
taller
I'm
than
6'4".
I think you're taller than that.
I love that his frame of reference is simply whether he can get in the car. That is the sole objective.
Lisa, you have no... Come on, Lisa, there's like 6 cars. This is a serious issue.
That's your first thought with Tom Brady? Really?
Brady's going to flog the car. It's going to be great. Everything's going to be
Are you more likely to rent one of those if Tom Brady advertises it?
Oh, yes.
Yeah.
Honestly, I think it's amazing how much money they're pumping into this. Are they going to save money with this? Is this going to be just basically an advertising pitch? From the Hertz perspective, I think this is fascinating as well.
I rented a car in northern New England, and they sent me the redo of the bill like 6 weeks later.
Who was driving it?
Oh, well, Mrs. Keene was driving it.
My. Oh, yeah, Tom.
Was it expensive?
Those rental car companies,
Oh, my.
I've been there a few times in Italy, Tom.
I told her, I said, the last time we rent a Bentley.
Was it a Bentley? Is that what it was? Is that what it was, Tom? It looked like an SUV when you sent videos of that. Anyway, Michael Nathanson's going to join us shortly from Moffett Nathanson on the news out of Facebook, and I'm sure Tom wants to talk about anything but. Futures are up 6 on the S&P. We're up about 0.1%. From New York, this is Bloomberg.
With the First Word News, I'm Laura Wright. West Virginia Democratic Senator Joe Manchin appears to be on board with White House proposals for new taxes on billionaires and certain corporations to help pay for President Biden's scaled-back social services and climate change package. CNN is reporting Manchin is okay with a $1.75 trillion package. That follows a meeting on Sunday between President Biden, Manchin, and Senate Majority Leader Chuck Schumer at the president's home in Delaware. China is warning that new COVID-19 infections will increase in the coming days after the latest outbreak, which is fueled by the Delta variant, expanded to 11 provinces. It locked down hundreds of thousands of people in the north, asking them to stay home. Officials are warning of civil and criminal penalties for anyone disobeying the order. Facebook has been concerned for months about its declining popularity among teens and young adults, but didn't let on to shareholders. That's among the accusations in a whistleblower's SEC complaint. Former Facebook employee Frances Haugen went public earlier this month with claims that Facebook has been prioritizing profits over user safety and security. Redacted versions of the documents were obtained by a consortium of news organizations, including Bloomberg News. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
Surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
you
drop
great.
the bow tie. Drop the bow tie.
What, skinny tie?
Yeah. I always say, this is my line, whenever anyone in America has a go at me about a skinny tie. The older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
Countries, Francine, that are the equivalent, that equal 80% of all the emissions. Those 20 countries, above all, have to step up.
Google is saying it has accelerated innovation in the country, and it's planning to appeal the FTC's decision. What's your take on this, and how do you plan for further scrutinies?
We are going to see what they make and what changes they are actually bring to this market.
The growth story in cannabis remains very strong, even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is the bottom, and it will just start getting a little bit better every quarter next year, but we're not going to see reasonable supply-demand balance until 2023. It just takes that long to build new capacity, to bring on new factories, to expand capabilities in manufacturing, and to see a rebalancing of the supply chain across the industry.
Things will get better. The message there from the Intel CEO, Pat Gelsinger, speaking to Bloomberg. From New York City this morning, good morning. Tom Keene, Lisa Bramis, and Jonathan Ferro. I think I said Pet there and not Pat. Pat Gelsinger. He won't be coming back. Futures up 8 points on the S&P, advancing 0.2% into the bond market. Yields higher by a basis point or two, 164.84. In the equity market, Tom, we have a lift this week. It's all about tech earnings from the big five through this week.
Let's dovetail in a couple themes here right now on tech earnings. My essay of the year, Ian Bremmer in Foreign Affairs Magazine, on the power and the strength of all these big tech companies. Just a fabulous look at where we're heading. And then, John, fold that into the power and the strength of Cupertino to say, no, we make the rules for our users, particularly of iPhones. And then you go to the power and strength and shock of Snap. John, we witnessed that last week.
It very clearly hurt ad spend at Snap. To what degree, I don't know. That stock absolutely cratered. And then we started to think about what it would mean for Facebook too. Let's have that conversation now with Michael Nathanson, the founding partner and senior research analyst at MoffettNathanson. Michael, let's start there. I've talked a lot over the last week about the supply chain disruptions, the fact that people might not want to spend because they can't meet the additional demand that spending might deliver. Let's talk about the change at Apple, how much it surprised the C-suite at Snap, and what it might mean later this week for some of the big tech players.
Yeah, good morning, Jonathan. I think that was the story at Snap last week. You know, it was nice to blame supply chains, but I think they didn't see the risk coming from those Apple changes on privacy protection. They were saying up until the last quarter, things are fine, we have this, do not worry, whereas Facebook was warning everyone. So supply chains definitely hurt autos and iPhone sales and technology sales, but I think that was a convenient excuse for what was probably misunderstanding the risks that Apple were bringing to their business.
That's the power of it all, Michael. Is Netflix part of this group? I found it interesting that Dr. Bremmer left it out of the essay. After Netflix, the subscribers, the mystery of streaming, which you cover better than anyone, does Netflix have power?
Netflix has power because they spend $18 billion a year in content, and their strategy is to basically just rifle shot new content every day. And it's hard to compete with that. But their business, we've argued in the past, doesn't have the same moat as Microsoft, Apple, Facebook, Google, Amazon, right? They're a different beast. The FANG acronym has been created, they're in it. But I don't think they're in the same business and the same type of moat protection that the other big five have. So it's in the conversation, but it's such a different business model than the other companies. You know?
Well, we've got 18 questions very quickly here, Michael Nathanson, before the others jump in. What's your single best buy now out an institutional short term of 3 years? Which of these myriad of names is the one that gets you excited?
This will surprise you. I'd say Facebook, which is printing results tonight. We're expecting a very tough quarter in terms of forward guidance, the Apple effect, supply chain comments that Jonathan was referencing. But the stock's trading at a markup multiple on next year's numbers. And it just seems to us that they're so well positioned, even with all those headwinds, for years and years of double-digit top-line growth. So it's Facebook, which I know is counted to a current consensus.
This, I really think we need to dig into a little bit more. You've got a price target of $420 on the Facebook shares, a really significant gain from where we are right now. And this comes despite some of the disclosures that we're seeing dribbled out from the whistleblower that's been testifying in Washington, D.C. What will get it to $420 a share amid all of this blowback, amid the Apple privacy rules, at a time when the shares are simply $324.61?
Okay, so Lisa, I've covered the stock for a while. There are times when you go through these intense spotlights on regulatory and business model pressures. I just think it's going to be quarters and quarters of good top line growth, and it's meeting expectations. And I tell you, there's been times in the past where we've seen the spotlight from DC and regulators, never whistleblowers before, and the stock just powers through because they've got a great business model. Even with the IDFA changes, the Apple changes, if you want to reach people for digital advertising, Facebook is one of 2 or 3 places to go, and that's where the growth is coming from. So, I know it's not comfortable to recommend Facebook here, given all we've learned about the company. But the business model is really, really well protected, given the long-term tailwinds that the industry is seeing.
Michael, you're making a really important point here that last week everyone took a look at what Snap had to say and they said, oh my goodness, any company that relies on advertising, digital advertising, is going to get sunk by supply chain disruptions. Are you saying that narrative is completely wrong, that those advertisers will keep advertising and that those companies that have adequately protected against the Apple privacy rules will be the ones that succeed?
Yes, I'm not saying that the supply chain risks are not real. I'm not saying that the IDFA Apple changes are not real, but Facebook has spent, 15 months warning us, investing in solutions. They have great first-party data. They're a different business than Snap. Where the weakness was seen at Snap was on app downloads and mobile games. Facebook has 10 million advertisers, right? So there's no doubt in the near term the pressures will be there from Apple changes and supply chain disruptions, however big they are. But Tom said on a 3-year view, I have a stock trading at a market multiple that's growing well in excess of the market. Seems to me that that's the place you want to invest in, right? So but Lisa, your concerns and things you've raised are there. I think Facebook has thought about this for a long time now, and they've done things to try to mitigate the damage from Apple's changes.
Michael, let's just finish on this just quickly. What would it take, do you think, for advertisers on Facebook to go somewhere else and pull back and say, you know what, this just feels really toxic and that's not a platform I want my company to be a part of anymore? What would it take?
Okay, so Jonathan, there are 2 types of advertisers. There are brand advertisers who are there to amplify their message and their brand and to be around content that they like. I see that as a big risk, that Facebook advertisers or brand advertisers will leave, but that's a small portion of their ad base. The core portion is performance advertisers who are putting out messages where they want a response, an app download, a site visit, a purchase checkout. Until the ROI, the return on investment, starts to really wane, they will keep spending. They're not there for the branding elements of Facebook. They're there to push a commerce activity.
Right.
So Jonathan, until that really weakens, they're going to spend, right? It's supply and demand. The problem is there are not a lot of places to go outside of Facebook to reach that many. And it's more than Facebook, it's Instagram as well, right? So there's a broad patch of consumers out there who have historically clicked to buy, clicked to download, clicked to rent something, thanks to Facebook, right? So until that really weakens, they have them.
That final point is so important. Michael, it's great to catch up. As always, sir, thank you. Michael Nathanson there of MoffettNathanson. Tom Keene, elsewhere crude. WTI with an 85 handle.
Well, yeah, again, catching up. And you look at Brent crude, 86.48, hasn't moved. And, I'm sorry, West Texas lifts.
We got a rally in this commodity market. More on that still to come from New York City on radio, on TV. This is Bloomberg.
what we can diagnose, so it's more about peace of mind and determining whether they do need to be seen in person.
So if someone wants a leader, is it better to find a general or an admiral?
That's like asking me to say, who do you love more, your son or your daughter?
Live on TV and radio for our audience worldwide. From New York City, this is Bloomberg Surveillance alongside Tom Keene and Lisa Abramovitz. I'm Jonathan Ferro. Your equity market shaping up as follows. Up 7 on the S&P. We advanced by a little more than a tenth of 1%. Into the bond market, yields are higher by 3 basis points to 166.43. And there's the move. There's the number on crude, 85 on WTI. The first time we've been able to say that one, TK, since 2014, up 1.5% on the day.
Now, that's the market moves, and it's a tertiary piece of economic data, John, but Chicago Fed National Activity Index has a negative statistic.
A slip, Tom, for the month of September.
And the revision is well on to the edge of it.
Yep. Not a pretty read, Tom. That's for sure.
Read.
Dallas Fed manufacturing activity coming out at 10:30. Yeah. If you want another regional read, Tom, it comes a little bit later this morning.
Do we have the perfect guest to talk about this? I think we do, John.
Sarah House joining us now, Tom.
Sarah House with us with Wells Fargo, and this is one of those tea leaves that you use in making adjustments. I guess my question, Sarah, is on a Monday morning, diving into all the information flow of the next 2 weeks, where's your item of greatest doubt? And let me reset that question to where's your item of greatest doubt when Chicago Fed national activity shows 2 tepid statistics?
Well, I think when we're looking at just the broader activity, so we did see some moderation continue in September. So I think the Delta variant was still hanging over the economy and people's activity and spending decision. But I think really what we see in the third quarter and September as we were seeing supply chain issues really come to the fore, as well as the Delta overhang. I think in many ways this is somewhat of an air pocket. And I think looking forward, we still expect activity to pick up here in the coming months. But I think a big question hanging over the outlook remains inflation in terms of how high it gets and how corrosive it really gets to consumer spending.
Okay, well, we're going back and forth on this morning, and actually a fair amount of shouting out on Twitter about it as well. Sarah House, educate us. When you study and guess inflation, what part of our price change do you study and guess?
So when looking at inflation, we are looking at the rate of price change. This isn't about the level, but it's how much prices are changing. So I think even as we talk about inflation, that rate of change, I think we are going to see it get worse before it gets better. So we're expecting the consumer price index to have a 6 handle on it later this year, and that'll probably persist through the first quarter. But then when we get later into 2022, so we're going to have some pretty tough base comparisons in the second quarter. And I think when we look at what's been driving these price gains, these bottlenecks, the fact that demand has been so strong, I think that demand element has been underappreciated in these so-called supply chain issues and these supply constraints, that we do have an inflation receding later on, just as, again, this isn't so much about the level of prices, but it's about that rate of change.
What's the appropriate rate that the inflation rate can recede to, where Fed officials will be comfortable staying put or not hiking as soon as the market is expecting them to?
So I think if you see inflation recede back towards their target, so roughly 2%, I think that does give them some confidence that they can continue to take their time in raising rates. So we don't think that they'll actually be raising rates until 2023. We think the market's priced in probably a bit too early for when that liftoff occurs. But I think the fact that you just see inflation receding back towards the target over the second half of next year, I think that's going to help the Fed be patient and continue to wait for more workers to return to the labor market and that labor market picture to strengthen without getting too worried that inflation is becoming unbridled.
Sarah, how do you square that idea that, frankly, the Fed endorses that inflation will come down significantly next year with the idea that company after company says that supply chain disruptions, labor market shortages will persist well into 2022, if not into 2023?
Well, I think it goes to the fact that, again, inflation is going to get worse before it gets better, but we are going to see these supply chain issues ease over the course of the year. I think we are going to see workers come back into the labor market more forcefully next spring. That's going to take some of the heat off some of the current wage pressures that we're seeing. And so I think even as you have inflation remain elevated overall, it's that direction that the Fed is focusing on rather than the outright near-term magnitude.
12-month out, what's your year-over-year economic growth? Frame that for us at Wells Fargo.
So for Q4 next year, we're still around 3.5% GDP year over year. I think that the composition is going to look better than what it's going to when we get the third quarter numbers this Thursday. So the fact that Thursday's numbers are going to be very much driven by inventories, not necessarily that inventories are being rebuilt, they're just not being drawn down as significantly. So I think that's really going to obfuscate some of the weakness that we did see in Q3, both in terms of real spending and the fact that we still can't source enough materials and products in this economy. But I think we get a few catch-up quarters later in 2022, which is going to keep that keep growth later in the back half of the year above trend. You know, consumer balance sheet's still remarkably strong. Labor market income is growing very, very strong as well. So maybe for individuals, real earnings, they're getting eroded right now by inflation, but you still have hundreds of thousands of people coming back into the labor market and seeing higher earnings, and that's going to keep consumer spending on a strong track.
Is it a service sector pickup Q2, Q3 next year? Is that what we're missing right now, and we're going to get it later on?
Exactly. So we're going to see that pivot back towards services accelerate. So we've seen some demand for goods ease up over the past 5 months or so. So durable goods peaked 5 months ago. Durable goods spending in terms of real terms peaked 5 months ago. But I think once we get to the end of cold and flu season, as you see people more confident about going out and spending, I think you will see that shift towards services accelerate. And of course, as you see that pivot, that's also going to help relieve some of these bottlenecks that we continue to talk about.
We're speaking with Sarah House of Wells Fargo, senior economist. And Sarah, one of the biggest questions that people have right now is whether we're seeing a sea change in the employment market with a shift of power to labor. And this goes to the job openings that we've seen and the idea that the skilled labor has been really missing for a lot of companies. How much do you see evidence of that shift in power to labor?
I think we're seeing quite a bit of it. Anything from the job openings, whether it's the JOLT survey, the Indeed job openings as well. I think we're certainly seeing it in the wage numbers. You know, last cycle we saw that businesses were absolutely loath to increase pay. It was the absolute last thing they wanted to do. And of course, here we have average hourly earnings up 4.6%. So we'll get a better look at what's happening with those wage and pay dynamics when we get the ECI out on Friday. So I think importantly there, it's going to also show us what's happening across benefits. So of course, we've seen these headlines about the absolute pay, but what's happening in terms of perhaps those one-time signing bonuses? Are companies having to hold the line a little bit more on the benefits to account for these nominal wage increases that they need to lure workers back to the job site? And so I think that'll be an important factor, as well as we think about the composition of this. So I think one thing we've seen is these wage pressures particularly concentrated in lower paying industries, whereas as higher paid workers are flexing that power more in terms of non-pecuniary benefits. So where they work from, how many days they have to go into the office. And so that's a little bit of a different calculation in terms of how that filters through to inflation as just the pure wage dynamics to get some of those in-person lower pay service workers back to the job site.
Sarah, if this shift really is going on, why is it that inflation won't be stickier than a lot of people think?
Well, I think we have to remember what happens with productivity. So productivity is a way that we can afford to pay our workers more without actually having to pass on those costs, quarter after quarter. And so I think that's a factor that I think it keeps the inflation outlook from becoming uncontrolled. So we've seen, of course, major investments across all types of businesses over the past 18 months, and I think including in some labor-saving technology as well. And so I think that's a factor that's going to help keep those wage costs under control. And again, I do think that we're going to see some supply return, and so I think that's going to have these wage pressures that we've been seeing more recently ease up over the back half of 2022.
The constructive outlook there from Sarah House there of Wells Fargo. Sarah, thank you. Thank you very much. Coming up at the Open in about 21 minutes from now, we'll catch up with Joanne Feeney, Advisors Capital Management Partner. Tom, we'll be talking about the week ahead, dominated by the week ahead's earnings from big tech.
Well, not only the earnings, but the revenue. I really can't say this enough, John, and John Stolfus at OPCO, I think, really laid this out nicely. Sure, there's the earning dynamic and all that, but his modeled revenue number is 16% up for the 117 companies that have reported. John, I did not expect that.
Well, for the top 5, what did I say earlier from Bloomberg Intelligence? 19%
Is that the
up
number?
for revenue.
Thank you. I didn't know
for
that.
revenue, yeah.
Thank
Lisa,
you.
the numbers are just fantastic in terms of what people are expecting.
Which is really, frankly, the story of earnings. The idea here that people have seen the supply chain disruptions, they know that prices are going up, they know that it's going to crimp margins, but it hasn't in so many cases, and sales have just remained so robust. It hasn't crimped demand that much. I think that is a really big story, John.
It's my favorite week of earnings, guys.
Aww.
Tech earnings. That's why I'm taking Thursday and Friday off.
To celebrate?
Just to celebrate and look ahead to next week, which is what we really care about, right? Payroll's Friday next week, and the Federal Reserve on Wednesday. Yeah. Tom, the Bank of England on the Thursday.
Week off.
Next week. You're off next week?
I'm the whole week.
You're off the Monday.
Yeah.
I've seen your diary. Tom Keene.
I'm glad somebody has. Am I off Monday?
You're off Monday.
I didn't know that.
You put it in.
No,
You didn't?
No, I didn't. One of my handlers.
All right, well, I can confirm you've got a long weekend, Tom. I approved it last week. You've got Monday off.
John, okay. I'm recovering here. I watched Purdue lose to Wisconsin.
How did that go?
It didn't go well.
Did you watch Bama get it done?
No, I did not.
Back on track. Good to see.
And we got Michigan State coming up, which we have to talk a lot about this week.
That's a tough run.
That's like the game of the century.
We can spend the week talking about a team.
Yeah.
Why are we talking about Purdue?
Well, I don't know.
Okay. Tom Keene.
I like them because their uniforms look like the Colorado Buffaloes. That's why.
Tom Keene, Lisa Abramowitz, and Jonathan Ferro. Lovely. Good show. Up 7 on ES&P.
We won't miss you, John. Goodbye.
And don't you won't. I won't miss you either. This is Bloomberg.
Man, it's live.
With the First Word News, I'm Laura Wright. A big move for the car rental company Hertz, which is barely 4 months out of bankruptcy. Hertz has placed an order for 100,000 Teslas. It's the first step of an ambitious plan to electrify its rental car fleet. It's the single largest purchase ever for electric vehicles and amounts to about $4.2 billion of revenue for Tesla. US labor shortages will persist into 2022 and contribute to a permanent increase in business costs. That's according to the latest survey by the National Association for Business Economics. Some 36% of respondents currently experiencing worker shortages said they expect them to end at some point next year. None see it happening before the end of 2021. 14% see shortages abating in 2023 or later. Turkey's lira fell to a record today amid the country's ongoing diplomatic spat. Already under pressure following a larger than expected rate cut last week, the currency slid again after President Erdogan said the ambassadors of 10 nations, including the US, Germany and France, were no longer welcome. The countries are demanding the release of a prominent businessman and philanthropist. The military figure who heads Sudan's Sovereign Council says a new government will be formed hours after the Prime Minister and other officials were arrested in an apparent coup. The army leader declared emergency law across the country. Sudan has worked to end its international isolation since mass demonstrations overthrew the long-time dictator back in 2019. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
When you look at technology, how should we be looking at big banks and technology?
Technology is our friend. So it's helping us transform the bank fundamentally. And in fact, we're speaking, I think, as we speak, to our shareholders around what we've done and how we've transformed the bank. We also see technology, and technology companies as partners. So some
Not
of our
rivals.
You know, we know that there are big parts of what have been our business historically that will be absorbed into convenience platforms. And by convenience platforms, whether that's Amazon or Facebook or Alibaba or Tencent or something like that, those are platforms that are just very convenient for people to conduct their day-to-day financial affairs. And it'd be very difficult for a bank to compete with that. Now, in some cases, I'd say, let's say in Africa, we are setting up a competing platform to the convenience platforms. And we're working with technology companies and mobile telephony companies and others to create a platform of our own. But for the most part, we're going to be playing on somebody else's platform.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
OECD nations need to end coal use by 2030, developing nations need to follow suit by 2040, and we need coalitions of solidarity between countries that still depend heavily on coal and countries that have the financial and technical resources to support transitions, because it is essential that no more coal power plants are built.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
What we're waiting to see, the gas supply side normalizing. If the gas supply side normalizes and we see that the price is still at this level, then we know we have to do something about it.
There we are with Tim Silva, the Nigerian Minister for State Petroleum Resources. This is global right now, and it's also very much domestic, as seen in a gallon of gas. Wait for the heating oil numbers of this winter as well. Prices are lifting. Again, West Texas, average up $85 a barrel. Brent crude just $1 higher, $86 a barrel. On their way, it appears, higher. Ellen Wald has been kind enough to join us many times with the Atlantic Council, a senior fellow. Her book, Saudi Inc., is absolutely definitive. In Riyadh, Ellen, right now, what are the new elasticities? There are lessons learned along the way, and then there's the changing or the percent change of the change that they can do, particularly in supply. How close are we to a supply adjustment?
I think that right now, Riyadh is very confident that they are progressing along the right path. Definitely for them, I think that they see the fact that there is definitely tightness in terms of supply and demand as a positive thing right now. They were very shell-shocked by what happened in 2018, which was we saw Brent hit $85 a barrel, and then under pressure from the U.S. and others, OPEC Plus opened the taps, and the next thing they knew, it was December and prices were at $50 a barrel. So they're very much reacting to what happened then and do not want to see a repeat.
And that's really the question, Lisa. What do they react to if it isn't the single point price of $86.31 a barrel?
And what are they looking at in terms of the swing producers? Because ultimately the shale patch had been the swing producer, and now that's being called into question a little bit more. Ellen, how much is that part of the issue that frankly gives Saudi Arabia confidence that they can wait a little longer and not cannibalize demand?
Exactly. I think, and we have to understand that they are in close contact. I mean, they maybe not quite as close as the contact between Russia and Saudi Arabia, but they know, what's going on in the shale patch. They know these CEOs. They understand what their considerations are. And so they have a good sense that, yes, we're going to see some growth in the shale patch, but it's not going to be anything like the kind of explosive growth that we saw in years prior. So I think they're fairly confident about that. One of the things I think they're also looking at is they are very concerned about the fact that a lot of this climate rhetoric has been hurting investment in fossil fuels. And so having these higher prices right now kind of brings home their point that, yeah, fossil fuels are still a really important part of the energy ecosystem. And I do think they would like to see some of that pressure and that rhetoric abate a bit, especially when it comes to them, despite the fact that they're going all out and making these net zero pledges at the same time.
Ellen, this is really important, and I'd love for you just to basically put a bow on this. The idea that maybe they like the higher price because, frankly, it sends a message to the energy sort of efficiency debate, the green energy debate, the idea here that if you want it, you'll have to pay for it. In the meantime, you're going to see our oil prices continue to go up.
Exactly. I don't think it's quite an idea of retribution, but I do think that they have been battling with this climate messaging of saying, yeah, we care about this. Yeah, this is a big issue. But at the same time, the alternatives to fossil fuels aren't there. You still need us, so stop treating us like we're disposable. And so this is an opportunity for them to say, look, now you know we're not disposable and you need these fossil fuels, so let's tone down some of the very anti-fossil fuel rhetoric. And we saw that with these documents that were released that show that Saudi Arabia and some other oil producers have been lobbying the UN to try to tone down some of that anti-fossil fuel language in a new climate report.
Ellen, long ago and far away, Lisa Abramowitz paid for the offspring's education by picking up West Texas Intermediate futures at a large negative statistic. I believe this was April of a year ago. Brent crude maybe never got there, but Brent crude was dirt cheap. How rich or richer or richest is Saudi Arabia in the last year and a half?
They've made a lot of money. And as they continue to put slightly more barrels on the market each month, they're going to continue to make more money. And I think that they see in some respects, and they might not voice this out loud, but amongst themselves, I'm sure that they see that this is almost in a sense they're right, because they have suffered through very low oil prices. They've done actually quite well throughout a period of very low oil prices, and they undoubtedly want to take advantage of these high prices as they can now, with the understanding, right, I think that they understand it can change very quickly, and especially with these developments in China in terms of another coronavirus outbreak. They're keeping a very close eye on that.
Hey, Dr. Wald, I want you to pretend you're a market economist or oil expert now at a big Wall Street firm. What is the price statistic for Saudi Arabia of Brent crude and the collar around that, where they're satisfied with that as a price?
I think they're pretty satisfied with anything between they're very happy with over 70. I think by the time we hit 90 or triple digits, they may be getting a bit nervous about some demand destruction. So we're definitely still in the range that they're quite comfortable with.
More than the collar, yeah. This has been wonderful. Ellen, thank you so much.
Ellen, thank you.
I appreciate it. With Atlantic Council and senior fellow as well. I'm doing it in my head, Lisa. That's why I paused there. I was trying to do the math of what that means for a gallon of gas.
Yeah, I thought you were just focused on the collar aspect. Which collar goes best with a bow tie?
Yeah, that's true. But, you collar it. You don't have an individual statistic, but what is it? I don't know.
I want to dovetail that actually into something else that I'm seeing in the market. The idea here of persistently higher oil prices is something structural. I'm wondering how much that really feeds into the 10-year break-even rate, which now is the highest since 2006. I think this is fascinating at a time when so many people are wondering what the meaning of the T word actually is. If persistently transitory means anything to anyone, we're at 2.66%. That basically is that in 10 years, the expectation is, at least based on break-even rates, that the inflation rate will be just south of 2.7%.
And I'm so glad you brought this up, because this is a conundrum. The break-even moves higher, folks, pre-financial crisis, and yet the 10-year real yield is just a negative 1.00. They're really not the same thing, are they?
Completely different. And the question is why? How much is Fed intervention, or how much is this, frankly, something that is bigger and that is going to remain? And frankly, the answer will really drive, frankly, risk appetite, because if those yields go materially higher, real yields, that will be a different equation for Wall Street.
This has been exciting. What an interesting Monday it is as we dive into an earnings week that really starts with a vengeance. On Tuesday, there'll be much more forward. Green on the screen here, a nice lift to the market. Futures up 7. Ambassador Haas with the Council on Foreign Relations. Look for that. Good morning. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Getting your trading week started live from New York City for our audience worldwide. Good morning, good morning. Your equity picture looks like this. Up 6 on the S&P, advancing about 0.1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with the big issue. An earnings-fueled rally staring down higher rates.
It's an earnings story. That's been powering the market higher. Stock multiples are actually down over the last year.
This idea of rising rates?
Rising interest rates is a sign of confidence in the economy, not a problem for stocks.
Every quarter point hike by any central bank has a magnified impact on financial conditions.
Considering pulling back and tightening monetary policy.
We don't think that there's a lot of pain trade in seeing rates go much higher.
And that's been the story over the last month.
The way you combat that is with record profits.
Our profits are going to continue to be quite robust.
As we move our way through earnings season,
companies are coming through pretty strong.
You're seeing tremendous amount of money continue to come into the financial markets.
Joining us now to discuss, I'm pleased to say, is Invesco's Matt Brill, John Hancock's Matt Miskin, and Joanne Feeney of Advisors Capital Management. Joanne, let's begin with you. Futures up another 6. The S&P 500 looking at all-time highs again, potentially around the opening bell. Can earnings keep getting it done from your standpoint?
Well, Jonathan, I think it's going to be a mixed earnings season, and investors should be prepared for that. You know, clearly we have some very strong secular drivers out there, and I think that the tech companies are really well positioned to continue to grow. On the other hand, we do have wages rising, and that could easily crimp margins. So the big questions investors should be thinking about this earnings season is which companies are able to pass along those higher costs into higher prices. Where is the demand most robust? And then which ones will continue to deliver growth, not just for this quarter, right, but through next year and to sustain those multiples. So we think secular growth drivers are pretty strong, and investors need to have good exposure to some of those bigger tech names, as well as some unique smaller names exposed to some of the key secular drivers like 5G, even housing, consumer spending. These are all areas of continued strength, we think, going forward.
Straight away, we're talking about pricing power here. Let's bring in Matt Miskin. Matt, where are you finding that pricing power at the moment?
I think Joanne's right. You know, technology space is one that can see pricing power and good balance sheets, good margins. It's going to be a war on margins going into next year. Higher wages, higher interest rates, higher input costs nearly across the board. So you've got to start with the margin screen, in our view, looking at the overall market. So communication services, technology, healthcare is one that we're really getting more positive on. It's more defensive, it's lagged, but that could be a winner next year. So you've got to find those companies in those sectors that can have good margins into a tougher year going into 2022.
A war on margins into next year. That next year piece of it. This was Chairman Jay Powell. He said the following going into the weekend. The risks are clearly now to longer and more persistent bottlenecks and thus to higher inflation. Matt Brill, it's gone from year end, talking about September, things starting to heal, into next year, mid-22. What are your thoughts on the calendar now, Matt? Matt Brill.
Yeah, see you in June, right, Jonathan? That's the new phrase. So
I think you have to look through to several months out because the next few months are going to be very challenging. The Fed's trying to figure this out. You heard Powell Friday. I think the biggest thing that he said is it's time to taper. It's not time to tighten. So he does understand this. He's trying to give it enough time to let the labor markets play their way out, let the supply chain issues play their way out. But the next 3 months are certainly going to be a challenge for him and for the overall markets.
We are frustrated on this program by the phrase transitory for longer. We got a flavour of that from Secretary Yellen over the weekend, speaking to CNN. Take a listen.
We are going through a period of inflation that's higher than Americans have seen in a long time. And it's something that's obviously a concern and worrying them, but we haven't lost control. And as we make further progress on the pandemic, I expect these bottlenecks to subside. Americans will return to the labor force as conditions improve.
Will conditions improve? Matt Miskin, Matt Brill said, I'll see you in June. Matt Miskin, will conditions actually improve next year? I'm going to be talking about China later in the hour. The COVID numbers don't look good as far as China's concerned. I see more restrictions, not less. How much longer can this go on for?
Yeah, it's certainly taking longer than everyone expected. And the Fed, Powell on Friday, I think, really came to a realization, coming forth, saying this is going to be longer than we even thought. The problem, though, is as an investor, is that, look, if you bought flood insurance for higher inflation or insurance on your portfolio for higher inflation, good for you. It's here. We're in this period. I mean, you've got the hyperinflation versus transitory battle going on Twitter and everywhere else. Hyperinflationists are really coming out, but that's usually when it's most priced in. What the cheapest parts of the market are right now are the disinflation and deflationary assets. That insurance is really cheap right now. So actually, we would start to trim some of the hyperinflation, the real inflationary beneficiaries here into this strength and start thinking about disinflation insurance, deflation insurance into next year, which could be a slower growth environment and one where the Fed is going to have to, is actually going to have to maybe pull back on some of this hawkish talk that it's seeing right now.
Matt Miskin, don't wind me up with the H word. I'm already wound up about the T word. Talk to me about the D word now. You're mentioning deflation. You're driving me crazy, Matt Miskin. What have you changed then, just in terms of what you're leaning into and what you're leaning out of in this market at the moment?
Well, I mean, right now, the mid-cap, the cyclicals, the energy, you see oil going up every single day. I mean, it's overbought, but it just keeps going up. And we just see that there's a lot of bidding into this inflationary complex. But right now, no one wants treasuries. No one wants protection from lower volatility assets in a portfolio. And that's actually when you want to start looking at it. We think this cycle is going to be a lot quicker than the last one because the Fed's going to have to act more quickly. This is a shorter cycle, 3 to 5 years, and you've got to be able to pivot along the cycle. Think about new asset classes into next year that are different than this one, which is all about the inflationary complex.
You mentioned commodities, 85 on WTI for the first time since 2014. WTI crude up by 1.5% going into the opening bell. You mentioned higher rates as well and whether to lean against that story. Bank of America joining a chorus of people now bringing forward their rate hike predictions, saying the following: we raise our inflation outlook on supply side constraints and stronger rents and pull forward the first rate hike. We now expect the Fed to begin hiking rates in the fourth quarter of 22. Joanne, I want to bring you into this because you think monetary support is no longer critical to this recovery. So I just wonder how relevant this conversation is on higher rates.
Jonathan, there are really two things going on. One is that taper, right, that's likely to come starting next month. And then the second one is when does the Fed start raising rates? And, as Alan Greenspan, who is an economic advisor to Advisors Capital Management, wrote in this morning's weekly commentary for us, he thinks that inflation is going to be a bit more persistent than most do, and that those supply constraints are going to last longer. On the other side, though, he does remark that productivity is rising, and that's going to very likely to sustain economic growth. So still, we're not looking very likely at an area of stagflation, but we should have investors positioned for that outcome. And so that's why, one of the areas to look is in obviously the financials, which do well in a rising rate environment, but also on the equity side outside of financials, finding companies that pay a dividend that's substantial and that is likely to go up more than inflation is another way that we're protecting clients from that inflationary environment to make sure their income goes up and stays ahead of that inflation risk environment.
So Matt Brill, we've got two sides of the trade there. Matt Miskin on one, Joanne Feeney on the other. Where are you?
Well, our thoughts are that this is transitory. I really think it is, but I have a feeling, and my concern is that you're going to have back half of 2022 potentially oversupply. If you get the Fed starting to hike and be restricting demand, and all of a sudden all the supply kicks in at the same time, to me that's my biggest concern. That's a long ways off, but I think that's a real possibility. So for me, I still think over the near term, the supply isn't there, and the supply is going to get caught up. And my concern is when a bottleneck explodes, it just all comes through at the same time.
Back end of next year, then, Matt Brill, build on that. Give me some numbers. Just paint a picture for me. GDP, inflation, CPI. What does it look like?
So CPI down to 2% by the back half of next year, possibly even less, because base effects you got to think about are going to look a lot worse next year, coming off of a lot of high inflation currently. So you're going to be having the Fed hike in the summer, potentially fourth quarter of next year, while demand is going to be dropping and the economy is going to slow. So we think you're going to still get north of 3% for GDP for the totality of 2022, but that back half of 2022 is certainly going to be slower with a lot less inflation. So lower for longer. The 2 and 22 that Krishna brought up on your show once before. I don't know if it's going to be there in the first half of 22, but it's going to be there in the last half of 22.
This is what I love about this moment right now in this economy, in this market for market participants. You've got really smart people on one side of the trade and really smart people on the other side of the trade. Some people saying if the Fed hikes, it's a policy mistake. Others saying if they don't hike, it's a policy mistake. Mohammed Al-Arian, ringing the alarm again, good friend of this program, writing on Bloomberg Opinion, he says the following: failure to respond quickly and fully to persistent inflation would constitute the biggest monetary policy mistake in more than 40 years. Joanne Feeney, is it a mistake to act or a mistake not to act?
Well, we know the Fed is pretty data-driven, and they're keeping an eye on this. Clearly, they have the view that a lot of the inflationary pressures right now are coming from these shortages combined with this big surge in consumer demand. If they act, we expect the taper, right, to come along soon, and that'll ease some of the pressure that's been holding down long-term interest rates, and we think that needs to happen. And then in terms of the rate hikes on the short end of the curve, mid next year, we think is pretty likely because that inflation is going to last a while longer. On the other hand, on the real side of the economy where production is happening, right, those shortages are going to ease. And when you look at a company like Apple, right, where potentially they might be constrained on how many iPhones they can build, their customers are so loyal that we don't think that's demand lost. We think that's demand deferred. And that means that the production increases, the revenue and profit increases are simply going to persist for longer. And that makes it a good environment for the equity investor.
Looking forward to hearing from Apple a little bit later this week. October 28th for Apple. In the pre-market, the stock looks something like this, negative by about 0.1%. No drama this morning. Matt Miskin, let me pull you up on this one right here. If that's your view on inflation and on rates and what the story looks like next year, where are you leaning into in this bond market? Are you along the belly of this curve? Are you pushing back? Are you long 10s at 165? What are you doing?
Still playing the roll down. The 10-year to 2 years pretty steep, and you're getting paid term premium to get it. We're slightly below the benchmark in terms of duration, right around 5.5 years. We're playing triple Bs in the corporate space and double Bs in the high yield space. And then we do have an allocation of bank loans, which is helping minimize some of that duration. But what we've looked at in mid-cycle environments, we do believe we're in a mid-cycle environment, it's just moving quickly, is you want to be a corporate bond expert. You've got to find corporate credit to manage interest rate risk. So you got to get better yield. We're looking at 3 to 4% yield in some of the corporates. Triple Bs have actually gained in yield this year. We would look at that attractively into next year. But overall, the economy is still strong enough to support balance sheets. A lot of these companies are looking much better than last year. So corporate credit is likely the antidote to this interest rate risk.
Matt Brill, do you share that view?
Yeah, we do. We think this is a corporate credit picker's market. This is generally a be concerned about interest rate risk, don't be concerned about credit risk type market. So we'd be overweight triple Bs. We'd also be overweight double B high yield. There's a lot of extremely large market cap companies that we think will be getting upgraded here. We're calling this the overdue upgrade, hashtag overdue upgrade. And we just think that the rating agencies are behind on this, and they're going to start coming through with a wave of upgrades.
Matt, does that include Tesla? Because around the opening bow, off the back of my colleagues reporting, Eric Schatzker reporting that Hertz is purchasing, 100,000 Tesla vehicles. That stock is going to be 1 trillion potentially at the opening bow. That credit is still junk. Matt, do we expect some moves around things like that?
Yeah. Absolutely, and I'll give myself a pat on the back. I've been an early adopter and owned a Tesla since 2013, but I never owned the bonds. So I would be more inclined still, if you think that Elon Musk changes the world, you want to own the stock rather than the bonds. But the bonds have gotten to a point now where the company is going to, it's too big to, I hate to say it's too big to fail, but essentially you've seen Tesla tap the equity markets to pay down debt in the past. They've really done a good job at this. But it's not just Tesla. You've got Netflix. It's $260 billion market cap with $18 billion of debt. You've got Centene, a healthcare company. You've got Roblox issuing a deal today. You know, Roblox, $50 billion market cap, give or take. Still rated high yield. This is not your parents' high yield. These companies are much, much bigger and much greater presence in the market.
The hopes and dreams of Tesla trading 4% higher in the pre-market right now. Matt Brill, Matt Miskin, Joanne Feeney sticking with us. Coming up on the program, entering a pivotal week for the Biden agenda.
With 90% of the bill agreed to and written, we just have some of the last decisions to be made.
Democrats racing to reach a deal. The latest from D.C. is next.
China is a gigantic part of our economic life and will be for a long time, for our lifetimes. But what that does not mean that we should be naive in the way that we look at our critical national infrastructure, the way we look at, you mentioned nuclear power, you mentioned 5G technology. Those are all legitimate concerns that any government, many other governments around the world have. But I've said this many times, it's worth repeating, I am no Sinophobe, very far from it. I think.
Do you think you're the last Sinophile in the cabinet?
No, I expect there are lots of. Look, China is a great country and civilization.
What about wind power? Would you let them buy offshore wind power? That's infrastructure.
I think you'd have to
railways.
You'd have to look at what was you're defining as strategic or critical.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
I wouldn't call that a wealth tax, but it would help get at capital gains, which are an extraordinarily large part of the incomes of the wealthiest individuals. And right now, escape taxation until they're realized.
Secretary Yellen speaking with CNN. Democrats discussing new ways of raising money for President Biden's spending package. This coming amid, quote, continued progress, according to the White House, describing talks between Senator Manchin, Leader Schumer, and the president over the weekend. Joining us now from D.C. is Bloomberg's Anne-Marie Jourdain. Morning, Anne-Marie.
Good morning, John. We are seeing a little bit of progress coming out of that breakfast. Call it a $250 billion breakfast. That's how much the president, according to CNN, was able to secure in terms of Senator Manchin, moving him from that $1.5 trillion line in the sand he had for the top line figure for the package to $1.75 trillion. Also, AP reporting that he's on board with these new ideas for the tax proposals. So what are they? Well, first off, John, we're still waiting to see exactly what those details are. Potentially potentially today, tomorrow, or Wednesday is the earliest we're going to be able to dig into what exactly these new quote-unquote billionaires' tax proposals will be. But what we do know is it would target about 700 people on unrealized capital gains. And what we do know from ProPublica reporting this summer, as well as others, is that a number of billionaires were able to really skirt income taxes. And this would be one way to try to raise the revenue in order to not increase the deficit so they can get through this social spending package. But I gotta say, John, they are really scrambling to get this done because originally, of course, they wanted to raise the corporate tax rate and income tax rate. But Senator Sinema was really a holdout to that. It does seem that potentially a number of individuals, those holdouts, are on board with this proposal. But then there's still a number of issues still, Jonathan, they need to debate. And it's a critical week because, of course, on October 31st, less than a week from now, they want us to be able to vote on this.
Wow. They've got to get to work, and quick. Anne-Marie, thank you. Anne-Marie Hordern, we were talking about a corporate tax hike. No conversation about that right now. We were talking about income tax hikes. It's moved over to taxing unrealized capital gains, which is terribly difficult to do. And that's been a big part of the conversation through the weekend and into this morning. Back with us is Matt Brill, Matt Miskin, Joanne Feeney. Guys, I want to bring you up a quote from Evercore and get your response from each of you. This is what Evercore's got to say. Despite the remaining disagreements, Democrats are more likely than not to agree on a framework for about a $1.8 trillion bill by the end of the month, even if some of their new tax proposals fall apart. I just want to understand if that's the base case for each of you or how your base case differs from the likes of Evercore. Joanne Feeney, first to you.
Yeah, I think it's realistic to view a much smaller package. 1.8 trillion doesn't sound small, but relative to where we started, it is. And both of these packages, the bipartisan and this Build Back Better, have elements of productivity investments in them. The physical infrastructure, obviously, the human capital infrastructure on the Build Back Better plan, better education, et cetera, getting women back to the workforce through child care and family leave, et cetera. So there are elements of productivity which make it a positive for equity investors. Obviously, the trick, though, is how to pay for it. And higher corporate taxes would be, negative for equities, but the amount there's potentially even talking about now looks tiny to vanishing. Higher income taxes is a little bit less of a problem for equity markets, although obviously would be painful for some equity investors. So our base case is we get something around that 1.8 trillion, and then we get the bipartisan infrastructure as well, which I think would be positive for future growth prospects for companies in America.
Matt Brill, is 1.8 where you're at too?
Yeah, we're in that ballpark, and we do think there will be some sort of tax policy, particularly around corporations, that'll be passed. So you're looking at probably 25% corporate tax rate, which for us is kind of it just doesn't move the needle. So that's fine. We're positioned that we think companies are positioned for that. We're expecting that if it happens to be less, even better from a corporate standpoint, worse from a U.S. Treasury standpoint.
Matt Miskin, what about you, sir?
We see this as a fiscal drag actually next year because these are going to be longer term benefits for the economy, increased productivity long term. But in the short term, you're probably going to actually have more negatives than positives for the markets because you're going to have to pay for it up front. You're going to have the higher taxes next year. And it's going to be like a time release pill in terms of this spending over years. This is much different than the stimulus we got in 2020 or 2021. Beginning of this year, the stimulus checks, that goes right into the system. This is a much more time release type stimulus. So we wouldn't bank on it much in terms of positioning. If anything, it might be a modest drag in terms of fiscal drag into next year.
Matt Miskin, I'm just piecing everything together that you've said so far through the first 20 minutes of this program. A fiscal drag down in D.C., lower growth at the back end of next year. We'd be talking about disinflation, in your view, your opinion. That just screams by tech stocks, doesn't it?
It is. It looks for those higher quality companies with good ROE, good margins, good balance sheets into next year. Technology, communication services, healthcare, the top three sectors in the quality indices. And we really believe fundamentals are going to be much more important next year. Earnings are going to be much harder to rely on in terms of broad-based earnings growth. It's going to be the top winners within every industry, and you've got to do the homework to find those companies.
Let's take a beat and build on this conversation in just a moment with Joanne Feeney, Matt Brill, Matt Miskin. You guys are going to stick with us. Coming up on this program, we'll be getting you your morning calls, and later, Facebook grappling with a host of negative headlines once again. The stock under pressure with big tech reporting through the week. Facebook down 0.8%. From New York City this morning, good morning, your equity market with a nice little lift once more, up 10. We advance 0.25%, looking to get a brand new trading week started in about 7 or 8 minutes. This is Bloomberg.
So the 1972 Madison Square Garden eyelet jumpsuit, which is arguably, from what we're finding out, probably one of the most important jumpsuits of Elvis's entire career. So it marked so many milestones, really, for him. It was used for an album cover. It was used when he performed Madison Square Garden, and he was the first performer to ever sell out 4 nights straight in Madison Square Garden. So he really started that whole thing that we see now in pop culture, where when you make it big, you do Madison Square Garden. So we're super honored to have it. I can honestly say that COVID has been unbelievable for internet-based and e-commerce businesses, because we have a captive audience. We have people home that really want something to do and need entertainment, so we do our best to try to give it to them.
5 minutes away from the opening bell in New York City this morning. Good morning to you all. Here's the state of play for you going into the open. Equity futures up about 0.25% on the S&P. On the Russell, up a similar amount. On the Nasdaq, a lift by 0.4%. In the bond market, switch on the board, 2s, 5s and 10s. I want to talk about the front end out to the belly. Big conversation right now on whether we're pricing in too many rate hikes into this curve. From 2s out to 5s maybe. 5-year right now is at 119. Your 2-year at about 44 basis points. If you think we're pricing in too much, do you take the pre-Misra trade over at TD and lean in, get long where the belly is right now at around about 120 on 5s. That's the bond market. Let's get you some morning calls this morning. Citigroup downgrading Carnival Cruise to neutral. The analysts seeing limited growth given the stock's current valuation and pricing environment. That stock is negative 2%. Your second call from RBC downgrading Whirlpool to underperform. The analysts warning investors about peaking earnings and management's overly optimistic targets. Your last call from Morgan Stanley raising its Tesla price target to 1,200. Analyst Adam Jonas citing the automaker's strengthening sales growth and unprecedented supply shortages elsewhere. That stock is up by 4.5%. They have executed and dealt with those supply shortages fantastically so far. Your opening bells next. It is a big week for big tech. This is Bloomberg.
nations need to end coal use by 2030. Developing nations need to follow suit by 2040. And we need coalitions of solidarity between countries that still depend heavily on coal and countries that have the financial and technical resources to support transitions, because it is essential that no more coal power plants are built.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Looking to build on the gains of the last 3 weeks. From New York City this morning, good morning to you all. 3 weeks of gains on the S&P, looking to add some weight to that rally. The S&P up 11, advancing 1/4% on the Russell, up 1/10 on the Nasdaq, up 0.4%. Huge week for the Nasdaq this week. That's the opening bow. Switch up the board. In the bond market, we shape up as follows. 10-year yield higher by a basis point to 164.31. In the FX market, euro weaker, euro dollar 116.11 and down 1/3%. Crude briefly with an 85 handle. Right now, 84.95, positive 1.4%. And at the open, this is what we look like. About 15 seconds in, advancing about 1/10%. Utilities, bottom of the pile, negative 1/10%. Top of the pile, the energy story, up by about 1 percentage point or so. I know you're very interested in what's happening with Facebook at the opening bow. The stock looks a little something like this, negative 0.8% to 321.86. Under pressure ahead of earnings amid revelations over its handling of information about user trends. With that reporting, here's Katie Lyons. Hey, Kaylee.
Hey, John. Well, some reporting from our team here at Bloomberg taking shares of Facebook lower this morning, revealing some pretty big issues. It's all based off of internal Facebook documents collected by whistleblower Frances Haugen, and it reveals issues around the company's use of treatment toward misinformation, fears employees have that the company isn't doing enough, that it may be inspiring violence because of hateful content on the platform. And it's not even just that. There's also user trends that were creating some concern at Facebook, specifically when it comes to younger users, teenagers in particular, between 13 and 17, but also declines in the 18 to 29 age group. And all of that news is weighing on Facebook today, which also, as we know, is the day Facebook reports results. It is heading into that print with a certain lack of momentum. The stock is down 15% from its peak back in September, weighed on not just by regulatory concerns, but also the results we got out of Snap last week, warning of a pullback in advertising spending due to supply chain issues, as well as changes to Apple's privacy rules. So we'll have to see how those dynamics read through for Facebook this afternoon. Revenue is expected to grow about 37% year on year to $29.5 billion, but that's only up 1.3% quarter on quarter. And it's really going to be the fourth quarter guidance that will be closely watched to see if at all any kind of slowdown is coming. All that said, though, John, the sell side still very positive on this stock. 80% of analysts say to buy it.
Kelly, right now it's down 1.4%. It's not a major move. Kelly Lyons, thank you very much. Tesla shaping up as follows, up by 4.5% in the early part of this session. Hertz confirming our reporting that they're purchasing 100,000 Teslas, bringing in revenue north of $4 billion potentially for Tesla. That stock up 4.5%. Let's call it 5. Let's call it $50 billion short of a $1 trillion market cap. Just unbelievable stuff for the likes of Tesla. Since we topped out on September 7th on the Nasdaq, this is the performance of the big four. Facebook is down about 16% from there. Amazon, Apple, Alphabet down about 5% from the highs in early September. It is all about big tech this week. We caught up with Dan Ives of Wedbush, betting on big cap tech to remain resilient. He wrote the following: this week is a World Series lineup for the tech sector. Third quarter earnings and guidance from tech stalwarts will be another positive catalyst, resulting in further multiple expansion. We see tech up into year end with our NASDAQ 16,000 year-end target. The bull is still bullish. There's the news. Matt Brill, Matt Miskin, Joanne Feeney, back with us. Joanne, can we start with the tech earnings this week and what you're looking for?
Yeah, John, we're expecting tech to remain resilient. It's likely because they have less labor intensity, right, in their costs, that they're going to weather the storm of higher wages better than other types of companies. So, the S&P earnings estimates, up 27-28% for the quarter year over year, we think is going to end up higher, and partly because the tech companies are likely to come in ahead of expectations, because those expectations have become a bit more conservative. So we're looking for positive results and good guidance from the tech companies, as their businesses tend to be resilient in this kind of an environment.
Matt Miskin, I know you like these names too. We touched on that briefly. Can you build on that for us, the kind of models, business models that you like?
Well, right now it's about business spending and consumer spending, and there's a lot of untapped cash to be spent. So these companies, businesses have a lot of money right now to spend, and where are they going to do it to get advertising? They're going to go where the eyeballs are, and the eyeballs are sitting looking at screens, and the screens are dominated by some major technology companies, and they're the ones that have the biggest moats. They have, basically all the market share, and so they're likely to benefit from that. Consumers are also spending. Retail sales hasn't gone down. It just seems to keep going up, no matter what has happened here. So, if we think about the consumer and the business spending, these are places that are going to benefit from that.
I want to prick up on the spending, the business spending, the ad spending. Snapchat really made the headlines in the last week, and there's two pieces to this broader story. One piece is Apple, the other is supply chain constraints. Snapchat was down about 26% at the close on Friday. Here's the performance intraday. Facebook down 1%, Snapchat up about 0.5%, Twitter down by 1.6%. And Matt Brill, I won't ask you about the individual names. It was just the fact that we're hearing from these companies that rely on ad spend, these names on the screen. ITV over in the UK, the CEO called up with Francine Lacroix earlier this morning and talked about auto manufacturers pulling back on spending because they can't meet the incremental demand that spending on advertising might fuel. Matt Brill, as someone in the bond market, what kind of signal does that send to you?
Yeah, well, it was mentioned the World Series lineup, so I have to do it. I've got to put my Jock Peterson pearls on for the Braves being in the World Series. So, I couldn't leave that one. Well, we're looking at tech, and they are able to. They're completely able to pass this through right now. But there's so much demand, you don't need to spend on advertising. I completely agree. So, the demand will be there in the future. I think you can kind of kick some of this to the first quarter of 2021. I think over the near term, it is going to be a tough, more of a tough to deliver in the tech space. So names like Apple, again, it's not demand destruction, it's demand delay.
Matt Brill, you've got to wear a pearl necklace now for the rest of the show. You have no idea what this looks like right now.
Take it off.
It looks like you've got earrings on too. They've got to stay there, buddy. They've got to stay there. Joanne Feeney, you said something interesting in your notes that I want to build on. The supply side shortages will ease, but it will support above normal growth in sales for longer. That this constraint story at the moment will support above normal growth for longer. Joanne, can you explain that?
Yeah, right, John, exactly. Well, as an economist, I can tell you, right, that these shortages are deferring the builds and the sales. I mean, think about the semiconductor industry. That's one of the key shortages out there. They're selling everything they can make, but it takes a while for them to ramp up more production capability. Factories take a long time to build. And so as the consumer demand remains strong, given those balance sheets, right, they're going to keep spending quarter after quarter after quarter. And so the semiconductor companies and the other companies that they feed will gradually be able to increase their sales. And so those sales are going to remain above trend. A stagflationary environment where GDP growth goes to zero is not the situation we're in. Right? We're in a situation where sales growth is going to remain positive and above long-term trends because those shortages are going to ease. And that's a really good investing environment for equity investors, which is, one of the reasons why we're continuing to suggest, right, and to build for our clients portfolios that include a fair bit of these secular growth companies, as well as, though, some inflation protection, because we are convinced that market interest rates are too low and they will have to go up. And there are ways to build that kind of protection into portfolios using individual stocks and bonds.
So walk me through those individual names then. Taiwan Semi, Broadcom, why those two?
Yeah, well, Taiwan Semi, obviously the semiconductor supplier builder for the world, they're one of the ones that as they add capacity, they're going to be able to sell everything they make. And we think that's going to last for, through 2022 as these shortages persist. On the flip side, you have Broadcom, which is a key supplier of some of the cloud computing equipment. And those cloud company enablers, right, need to expand the pipes because of all the data that's flowing right through streaming and other reasons. And we're in the middle of an upgrade cycle. So Broadcom is a key supplier of some of the chips for that, in addition to being a key supplier to the iPhone. So we like both of them, and they both have dividends. So those clients that are living on income, in their retirements, get to enjoy dividends from those two companies. We think they also bring appreciation, and those two companies are going to be increasing their dividends year after year, which helps protect against inflation for those clients living on income.
Joanne, it's interesting to me listening to what you've got to say and listening to what Matt Missin's got to say. On the macro story, there's a big difference, but on the stocks you like, the style, you both seem to like growth equity names, broader tech. Why is that, Joanne? Why do you have that different view on the macro, but ultimately, when it comes to tech, you like the same sector?
Yeah, well, I think that we understand that these shortages, particularly in the labor markets, are going to cause costs to go up for firms. So when you select, names for the clients, you've got to make sure that you have companies in there that can ride out those wage increases, right? Now, we build diversified portfolios for clients, so we're not just in tech, right? We have good exposure to financials, right, to give that inflation and interest rate protection, and consumer, because the consumer remains strong. There are plenty of other secular drivers out there, not just tech, like housing. I mean, look at the demographics of housing. That's one that's got a lot more years to go, given the shortage we have right now in new builds. And so that's another reason, back to your earlier question, John, why we think growth is going to remain above trend. Right, housing starts have been limited by shortages of people and materials, so it's going to take longer to catch up on the housing front.
Matt Miskin, final word.
Look, we got earnings season this week. No doubt that's going to be number one, but we got a Fed meeting after that. And I think really this is a paradigm shift for the Fed. They went to average inflation targeting. They really wanted inflation for 10 years. Be careful what you wish for. They got it. That's going to be the turn of the hawkish tilt of the Fed, and really at the November meeting. We think that eventually that leads to a shorter and faster cycle, and that's really what's going to drive the investment horizon over the next several years.
All I'll be thinking about tomorrow, guys, Braves Astros, 8 p.m. It's Matt Brill in a pearl necklace. Guys, thank you. Matt Brill, Matt Miskin, and Joanne Feeney. Enjoyed it. Thank you very much. Coming up, rising virus cases adding fresh fuel to China growth concerns.
It's hard to see where that growth is going to come from in China. It seems that the government in China is really sort of cracking down all over the place. So I think it's far from certain they're going to hit 5% over the course of the next couple of years.
The Delta variant sparking new lockdowns throughout China. That's the topic of conversation just around the corner. From New York City, this is Bloomberg.
Surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
you
drop the bow tie. Drop the bow tie.
What, skinny tie?
Yeah. I always say, this is my line, whenever anyone in America has a go at me about a skinny tie. The older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
They know me as Magnus TV in Facebook since I'm streaming Axie Infinity. Axie Infinity is an NFT game where you can earn tokens, and then that tokens can be converted into pesos. started, I'm playing almost 4 to 5 hours a day. I'm earning, I can say it's really a lot of money. It can help to sustain my family needs and also to sustain my own business that I'm starting. I'm a little bit worried about it because some people who join this Axie Infinity thinking that this is an easy money game, they can earn a lot on this game can sustain their life, and I think that is not the point, or that is not really the game. We are trying now to build a community where other players or my scholars can join this esport, playing Axie Infinity for now, even 5 years, I think.
20 countries, Francine, that are the equivalent, that equal 80% of all the emissions. Those 20 countries, above all, have to step up.
The short-term picture is that China is still under quite significant influence of pandemic, temporary lockdown, and as a supply chain. And the long term is that China is going to transform to a quality growth rather than only emphasizing quantity.
Delta outbreaks spreading throughout China, adding fresh fuel to escalating growth concerns. Goldman adding its name to the list of companies downgrading their growth forecast, joining the likes of Barclays, UBS, Bank of America, Citi, and Nomura. Joining us now is Bloomberg's Damien Sassoon for more. Damien, ultimately what matters for the growth profile, as you know, is the level of infections you need to trigger restrictions. And the level of infections in China is about that much.
Yeah.
That's all it takes, just a little.
They're the last ones pursuing the COVID zero policy, Jonathan. I mean, the likes of Singapore, Australia, New Zealand, they've all abandoned it. And what you're seeing is, if you look at, if you basically look at testing in China, if you look at the ability to close down the economy, it's far more effective. I think the frequency between outbreaks in the second half of 2020 was 60 days. It's tightened. It's now 12 days, which meaning they're becoming more frequent. We're seeing more close downs, more lockdowns, and certainly Beijing's ability to basically do it is second to none. So you're seeing that kind of impact growth estimates going forward for us. We're expecting, sub 4% GDP growth in the fourth quarter of this year, and we could definitely see it be below 6% in 2022.
Could we have sub 5 next year, Damien?
That's what people are kind of calling for, right? I think the thing about Beijing and about China, Jonathan, is they can, I don't want to say manipulate the data, but they can come up with anything they want. In fact, I remember looking back into the past when they didn't like the GDP numbers, they changed the way GDP was calculated. So, it's anyone's guess how China's going to respond to this, but certainly growth is going to be slowing, and that's our expectation.
We don't like the word manipulate, we like the word massage. You massage the data, smooth. Damien. Of course, you just smooth out the bumps and all of that stuff. Dollar lira's had a big morning. It's faded since. Dollar lira was staring down 10 a little bit earlier. That's a very different EM story, Damien. What's been going on?
Right, 975, all-time high. I think Erdogan and the Turkish Foreign Ministry has basically threatened to toss out the ambassadors from the U.S., Germany, and France, among 10 other nations. Not good news, but that's typically what happens when he loses his base of support. And opinion polls on the ground, Jonathan, are showing that's exactly what's happening. So Erdogan's losing his support base, and I think the way he does it is, the way he responds to that is by lashing out at the West.
So they cut rates last week. I believe we have a Brazilian central bank decision coming up, Damien. Nobody's expecting them to cut rates.
Yeah. Well, they're expected to hike by 125 basis points, right? Wow. I think they're going to take the Selic rate to 7.25. They're not alone. Colombia's going to probably hike rates on Friday by 25 basis points. We now have more than half of the major EM players all having hiked rates in the last, since May of this year. I think 11 of 20, and more to follow. It's really the low yielders in Asia that have kind of lagged the curve, and that's kind of where my focus is. Where are expectations falling behind where the terminal rate can be for a lot of these markets. You find that mostly in Asia, the Philippines, Thailand, Indonesia, et cetera. And you also find it in the low yielders like Israel. So, that's kind of what we're looking at, and certainly paying in the belly has worked, as you can well imagine, here in the U.S.
This has been tough for the likes of Brazil. The rate in Brazil right now, for people who haven't been following this, is 6.25, but we've had massive rate hikes already from the Central Bank of Brazil. Here's the range of estimates. The low is 7.25, the high is 7.50, 7.75.
Yeah.
So 7.50 is the median.
Okay.
So anywhere between 7.25 and 7.75. Damien, you're a man that follows this really carefully. We've got a slowdown in China. We've got higher rates in Brazil. They're not alone. We've seen it in Mexico, South Korea, Chile, Colombia. Take your pick right now. Do you think that when you speak to people in developed markets, they appreciate the scale of monetary tightening and the slowdown being experienced in places like China, minus the tightening, in EM, with all the tightening? Do you think they really can get their hands around that at the moment?
Well, not yet. No, certainly not. I mean, you could see that in the currency the currencies, right? I mean, that's really where you're going to see it show up most acutely, Jonathan. The fact is, EM currencies are down 7+% year to date. They are not rallying as these countries are hiking rates, and that's just because, quite frankly, they haven't gotten in front of inflation yet. They're still behind the curve, at least in the eyes of offshore creditors. I think there's going to be a heightened focus on the fiscal side of most of these economies. Can they handle higher rates? And I think that's where the rubber's going to meet the road, in my opinion. So I think that's really the next step. And then if, for those currencies that can handle it, you're going to see them start to appreciate, and I think that's going to be a telltale sign.
Who's got space to cut? It's China, isn't it?
Yes, they do. And we're waiting for that to happen.
Still waiting.
Yeah.
Still waiting. Damien, thank you, sir. As always, Damien Sassow there on our emerging market coverage over at Bloomberg Intelligence. Your equity market opening about 0.1% lower, 20 minutes into the session. The Nasdaq basically unchanged. Just a massive week for big tech reporting earnings through this week. Let's get you a breakdown, lift the lid on the equity market, get you a sector price action breakdown with Dave Wilson, our stocks editor. Hey, Dave.
Hey, John. You got 7 of the 11 main industry groups in the S&P 500 lower in early trading. Steepest drop, communication services. That's where you find Facebook, hurt by the latest revelations out of the whistleblower Frances Haugen. And yeah, they have earnings coming out after the close. And tomorrow, we get them from Google's owner Alphabet and Twitter, and both those stocks are lower as well. Disappointing figures out of Kimberly-Clark explain the weakness, at least in part, in consumer staples. Then you look at what's higher. You see energy, with oil getting above $85 a barrel in New York trading. That explains that gain. Consumer discretionary, that's the category where you find Tesla. In our reporting on those 100,000 electric vehicles that Hertz Global Holdings has ordered, well, that's certainly lifted that share. And also, you've seen Tesla's peer group move higher as well. It's represented by the Wilder Hill Clean Energy Index and a related exchange-traded fund. And on top of that, you got a deal, Bloom Energy, which does fuel cells. $4.5 billion over 3 years. They're supplying in terms of cells and equipment to South Korea's SK Group. And to put that in context, John, Bloom Energy ended last week with a market value of $3.5 billion.
Dave, you mentioned Kimberly-Clark. It's down 4%. It's early days, but this was the third consecutive time that company has had to cut its guidance. We heard from Unilever last week over in Europe. They've been able to put up prices and pass those higher prices on. What's happening at Kimberly-Clark?
Well, I mean, what you're seeing there is not unique to Kimberly-Clark. You could argue the U.S. producers are having a harder time because, we had results out of Procter & Gamble. It was a similar situation. Their costs were going up faster than their prices were rising, and that becomes the issue across a whole lot of companies at this point, facing, higher expenses for commodities and labor and shipping and all the rest. So, it's definitely a theme to watch as we go through the third quarter results.
Dave, thank you, sir. Thank you very much. Our stocks editor, Dave Wilson there. We'll cover the earnings through the week on Bloomberg TV and radio. This commentary from Kimberly-Clark, the CEO. The company has been, quote, negatively impacted by significant inflation and supply chain disruptions that increased our costs beyond what we anticipated. Again, this is the third consecutive quarter they've had to cut guidance. They go on to say they're raising prices to help counter the effects of a global supply chain crisis that, quote, is not likely to be resolved quickly. This just keeps getting pushed out into the back end of this year, and much more so recently. It's the middle of next year and perhaps even beyond. It was a September 2021 story, and now already Secretary Yellen anticipating a mid-2022 story. Chairman Powell seemingly going with that a little bit more recently. And a base case for most people in this market has shifted as well markedly. What has it meant for this market? Not much at all. The equity market is still near all-time highs, unchanged on the session, because the takeaway is, in the words of Joanne Feeney, that any profit right now that isn't taken in this quarter is deferred to the next one and beyond. It's a recovery that is delayed, not a recovery that is derailed. That's the consensus view still. Coming up, the market moving events you need to be watching. That'll be next in our trading diary. From New York City this morning, good morning. Your equity market down a single point. We're negative 0.03%. A busy week still to come with the big five in big tech set to report. This is Bloomberg.
If someone wants a leader, is it better to find a general or an admiral?
That's like asking me to say, who do you love more, your son or your daughter?
You talk about hiring aggressively at the moment. Can you walk me through how challenging that is at the moment? How difficult is it to find the right people?
Well, things have changed. Again, the world has changed under the pandemic, and you all know worldwide, you know, what the challenges with getting people back into the workforce.
Grace of God and the goodwill of neighbors.
Do you want to plan a deal by the time you leave for COP? Is that something you've expressed to Democrats?
That's my hope.
President Biden just moments ago, after he caught up with Senator Manchin, apparently it went well and maybe we could have some form of agreement this week. In the market right now, here's the price action. We advance about 0.1% on the S&P. Even Facebook has turned positive in the early part of this session. Early days, but it's turned positive. Russell. Small caps, Russell 2000 up about 0.25%. The Nasdaq up 0.2%. The Nasdaq is where the focus will be this week. The big five reporting earnings. As this week grows older, we get a better picture of the growth profile of some of the biggest companies, not just in the tech sector, but worldwide on the planet. That's the price action. Here's the trading diary. You will hear from the president a little bit later. You'll hear from him again at 1:45 Eastern. Facebook kicking things off on the tech side after the close. Alphabet, Microsoft, Twitter tomorrow. Then Apple on Thursday, plus US GDP and initial jobless claims and an ECB rate decision as well. And finally, we round out the week with personal income and spending data. It's Friday. From New York City, what a week we've got still to come. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
engine number one was able to do on the Exxon fight, it opened a lot of people's eyes to, I guess, the power that smaller investors can have. And I'm curious as to how other people can sort of look at what you did and use that is either a template or maybe just some sort of guide as to how they can sort of approach their relationships with other companies.
We founded the company in engine number one on the idea that we take the data, not ratings and rankings of ESG of the past, but we actually take the environmental, the climate, the social, worker data, and we simply use it to look at the valuation of companies and look at it over a long period of time. And so if you think about it that way, you own these companies. Everybody that owns the company, whether you're a big institutional investor or you're a small retail investor, you own the company. You have a voice, you have a vote every year.
Yeah.
And so our approach is, is to use the vote and engage with these companies over time.
But that's always been the case, I mean, at least in theory.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Google is saying it has accelerated innovation in the country, and it's planning to appeal the FTC's decision. What's your take on this, and how do you plan for further scrutinies?
We are going to see what they make and what changes they are actually bring to this market.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water, and it's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient